The earnings story still looks very much on track.
You have a situation where the fundamentals actually got stronger.
There is still a lot of uncertainty out there.
This uncertainty can pass. I still think there's a very good road ahead.
The bull market that started in October of 2022 has further to go.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday within striking distance of all-time highs. Equity markets bouncing back almost 10% from last month's lows as the White House is teeing up peace talks in the next few days. Attention turning to wrapping up quarterly bank earnings on Wall Street. Morgan Stanley and Bank of America up next.
The themes so far have been trading and banking on fire. Look, whatever you can say about what's going on geopolitically, volatility has been a good thing for these banks, and you see record quarters coming out. Morgan Stanley should benefit from that. Bank of America might be the more interesting aspect of this. A read on the consumer. So far, the look has been resilient in the face of higher oil prices. Do we hear the same tone coming from the leadership of Bank of America?
The market reset has been absolutely remarkable. A 10% move off the lows for equities, a 20% move off the highs for crude. The Strait of Hormuz still largely closed. This market has moved on.
The Strait of Hormuz is closed. That blockade, according to CENTCOM, is fully in effect. But the president indicating to a number of reporters yesterday that he is prepared to wind this down. And this comes ahead of reports that potentially we can get as soon as this weekend another round of peace talks. I thought it was interesting, though. The vice president yesterday, J.D. Vance, said the president wants a grand deal, a grand bargain. How long is that going to take? And at the same time, the market is completely ignoring this Washington Post report that more troops are headed to the region.
In the meantime, how much damage has been done? Check out the earnings. LVMH, MS. If you have got exposure to the Middle East consumer right now, you're getting hammered. Elsewhere, look to the US, to the banks, Citi, Wells Fargo, JPMorgan. Pick your bank right now. Ask for commentary on the consumer. Consumer still earning. The consumer is still spending.
And frankly, a lot of them point to the fact that earnings and inflation have increased much more than gasoline prices. So when you get a gasoline price that's close to what we're seeing now, or above $4 a barrel, $4 a gallon, a lot of the consumers can withstand that. Yesterday, the Bank of America consumer survey came out with respect to spending on cards. The same kind of tone that we've been getting all along. This idea that there is resilience. So at what point does it become painful? You know, you hear caution in these executives' tones simply because they have to, because it seems irresponsible if they don't. But it doesn't seem like they actually feel like the economy is turning over.
For the short term, though, for the luxury brands Jonathan mentioned, there is some serious pain. These Middle East shoppers are not showing up to some of these stores. And that's what we heard from Hermes when it comes to stores in France or Switzerland or the United Kingdom. And this idea of having that scarcity that Hermes is known for, well, it doesn't work if your shoppers can't even travel to get to the destination.
That is not a problem for the S&P 500. And that's the issue for this equity market. Semis have ripped 20% so far this month. You want to talk about a valuation? $800 billion possible valuation of Anthropic. So this market's going to be wide open potentially for an IPO later on this year as well. All of that's lining up to benefit the likes of Morgan Stanley, the likes of Bank of America when they report later this morning.
Yeah, the idea that Anthropic is getting the offer of a valuation of $800 million, and they might $800 billion, and they might turn it down because they might not want to raise this round of funding. The idea that they could IPO in October. This capital market is wide open. And say whatever you will, there has been a leadership shift. You talk about this with the semiconductors and how they're up almost 30% in the past 10 trading days. There's also ASML coming out and actually raising expectations because still the investment in big tech is ongoing at an existential risk.
What did Jim Zelter say over at Apollo? Take a walk. In 6 months, we'll be talking about that. We won't be talking about all of this.
I'm walking a lot. I'm getting really sweaty.
You're touching grass. You're feeling good.
Just out there touching grass in the park. If you see me, just know, Jim Zelter sent me.
Equity futures on the S&P this morning, just about unchanged. Coming up this hour, we'll catch up with Noel Dixon of State Street with stocks on the brink of record highs. Susan Bell of Rystad Energy as optimism grows over an end to the war. And David George of Baird with big bank earnings in full swing. We begin this hour with stocks sitting near record highs as a relief rally takes hold. Noel Dixon of State Street writing, despite heightened uncertainty in the Middle East, investor positioning and flow data clearly suggests positive risk appetite is still alive and well. Noel, good morning. It's good to see you. Is there good reason to get behind this rally?
I think so. I think there's, to be, honest, that there is an awful amount of good news already priced in. However, I do think it can continue. I think the question is, after this situation has occurred, do we go back to the trade we had on before, or is it going to be something a little bit different? And I think, what our perspective is that we're going to be left with a situation with higher commodity prices. And then the question is, does everyone lose, or are we going to have winners and losers? And we're more of the latter train of thought. And we think that there's going to be more opportunity to be more selective. And we think that, the U.S., for example, it's hard to argue that they're not going to be more insulated from a terms of trade perspective. And there'll be some more weakness in other regions like the UK and Eurozone. So I think you have to be a little more selective.
Well, let's stay within the United States and get selective there. Pre-war, semis were doing well, software was not. Post-war, for the month of April, semis have ripped, software has struggled. Do you expect that to continue?
I do expect it to continue. I think the hardware, the semi story is undeniable. There's a lot of demand. I think software, we're trying to sort through what are going to be the disruptions from places like Anthropic and different companies. But, our perspective is that, we think, it's still going to be more of the same. And we don't see any reason to really change that perspective.
It seems like the leadership has very much been big tech, has very much been the semiconductors, as John mentioned, when you look at the sigh of relief being breathed by the entirety of markets. How much do you need to see corporate executives talk about actual efficiencies, actual gains coming from some of the deployment of AI to justify the ongoing rally?
Yeah, so I don't know if we need to see immediate justification. I think it's a clear race, between the U.S. and China, both, militarily and I think from a commercial perspective. And I think the perspective is that that's going to be ongoing. I think earnings right now, 12 months forward, it's about 30%. So it's really hard to get negative, especially after we had the correction that we did. So I think, right now, we do eventually need to see some revenue, but the demand is so significant, especially in the hardware space, that I think it still instills confidence in investors to move forward.
When I think about the demand coming from AI, and then you think about the fact that commodity prices, as you just said, will probably be higher, why has everyone moved on so quickly from this inflationary story that could potentially pressure yields higher and could create a really difficult situation for central bankers?
Well, when I think about the inflationary pressures, I think you also have to think about the growth side. So I think when we think about valuations, for example, and the support from an interest rate perspective, I think investors are skeptical that central banks will be able to hike as much as being priced in. So we would push back on that. So I think the growth aspect is going to keep central banks largely in check in the background. And again, we'll have to deal with inflationary pressures, but that was to my point earlier. There's going to be winners and losers, and that's where I think you have to be selective.
Is there also winners and losers when you look globally? Because the energy shock is really still hitting Asia and as well as Europe, and we're not feeling it as much in the United States.
Yeah, so I think it's definitely going to hit Asian countries. I think about South Korea. I think about Japan. They import 90% of their energy. But again, that actually brings some opportunity. So the baby will get thrown out with the bathwater. I think the Asia tech trade, there'll be some opportunities there, down the road as we get these corrections. But no question, I think Asia's very exposed. And as I mentioned, I think Europe is very exposed.
What would it take the market to care once again about the conflict? The Washington Post this morning is talking about sending thousands of additional troops. We always say, look at what Trump does also, not just what he says.
Sure.
But the market seems to be ignoring any sort of escalation.
Sure. So I think you need to separate two things, the nuclear agreement and I think opening of the Strait of Hormuz. From a market perspective, they're focused exclusively, I think, on the Strait of Hormuz. Keep in mind, for example, the JCPOA agreement with Obama, that took about 2 years to sort. So that's not going to get, I think, resolved anytime soon. It'll take some time. But the Strait of Hormuz, there is incentive, I think, for all sides to try to find some resolution. And I think that's what the markets are sniffing out and looking forward to.
And that's the carrot for the market right now. The president recorded an interview earlier this week with Fox News, getting some headlines from that conversation just moments ago. Maybe the end result will come soon, Bramo. And on the blockade, no pushback from the Saudis. There was some suggestion that there might have been some pushback from the Saudis. Not seeing that in these comments this morning.
No, and talking about how he sees the end as being very close, and ongoing sort of edification of what you're seeing in markets with respect to this sort of seamless effort toward a ceasefire. Look, I mean, Annmarie is not wrong when she raises skepticism. And I mean, I respect the Debbie Downer. I respect the fact that you can cast some cold water on this because, frankly, this conflict is not over. And you talk to any geopolitical strategist, they say the world has fundamentally changed. But the market has said, ultimately, to the degree that it's changed, we've moved on. President Trump seems to be leaning onto that, given the fact that higher markets seem to support him.
The world also has fundamentally changed, and so has Iran. I think the president always says there is a new regime. Not regime change, just change within the regime. Actually, these are hardliners as well. And they're going to come with the same hard lines to the negotiating table that their predecessors have. Also, what's interesting is Trump says that China had no pushback on the Hormuz blockade. I think that is incredibly interesting because China is the one that, of course, buys all the Iranian oil that the U.S. is now trying to stop.
Crude this morning, Brent crude at 95.80 at the front end of the futures curve, WTI at 92. The president saying that oil will be down to the levels it was and maybe lower. Now, I know the presidential jawbone can be effective, but that is quite an effort to jawbone this market a little bit lower.
The only way that could actually transpire would be if there was serious demand destruction on a mass level. And that would require some sort of decline in economic growth. But right now, based on the fact that you've had more than 10 million barrels a day taken offline and not coming online anytime soon, it seems unlikely unless you get some sort of serious slowdown.
No, you get that one. Oil will be down to the levels it was and maybe lower. No, Dixon, your response to that?
Yeah.
Don't fancy it?
No, I don't fancy it.
No Dixon Estate Street there. No, thank you, buddy.
Thank you.
Appreciate it. Let's get you an update on News Worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. The U.S. and Iran are looking to arrange a second round of peace talks in the coming days. Sources telling us here at Bloomberg the objective is to hold more discussions before a ceasefire expires next week. One proposal is to return to Pakistan, though other venues are being considered. Israel and Lebanese officials meeting for the first time in more than 30 years for high-level talks in Washington. The Israeli ambassador calling it, quote, a victory for sanity, even as officials play down hopes for an end to the war with Hezbollah. And prosecutors making a surprise visit to the Fed's offices this week amid the DOJ's investigation into Fed Chair Jay Powell. Sources telling us here at Bloomberg officials tried to enter the construction site but were denied entry because of clearance protocols. That's your Bloomberg brief. John.
Yahara, thank you. Thanks for the update. Up next on the program, the White House teeing up peace talks.
I think it's close to over here. I mean, I view it as very close to over. We'll see what happens. I think they want to make a deal very badly.
Up next on the program, we'll catch up with Colonel Wayne Sanders of Bloomberg Intelligence, live from New York City this morning. Good morning. The rally stalling out just a little bit, unchanged so far this morning on the S&P 500, unchanged on the Nasdaq. But what a move we've seen so far this month. Only one down day so far for the month of April on the S&P 500, a rally off the low of about 10% and within striking distance of all-time highs on the S&P 500. Now, that's at the index level. If you look at the energy sector has basically wiped out all of the gains on the S&P 500 that we saw through the month of March. That's amazing.
Especially given the fact that oil prices haven't come down to where we were before March. So ultimately, people are looking at this and saying it's pretty much a wash for them, given the fact that they've got destruction to some of their facilities in the Middle East, and they're not necessarily going to be profiting so much more from high prices. The market is treating this as though it's a blip, and we can all move on.
Brent crude at 96, right now WTI at 92. Under surveillance this morning, the White House teeing up peace talks.
I think it's close to over here. I mean, I view it as very close to over. You know what? If I pulled up stakes right now, it would take them 20 years to rebuild that country. And we're not finished. We'll see what happens. I think they want to make a deal very badly.
So here's the latest this morning. The president signaling he's ready to wind down the war in Iran, saying peace talks could restart in the next 2 days. Bloomberg's Tyler Kendall has the latest from Washington. Good morning, Tyler.
Hey, John, good morning. Well, our reporting maintains that both sides are seeking another round of in-person negotiations ahead of next Tuesday's ceasefire deadline. But that means that things have to get going quickly because President Trump indicated earlier this week that the timetable for a deal has not changed and suggested in an interview yesterday that he may not offer any sort of extension. There are signs that Iran is potentially trying to avoid some escalation here, at least in the short term, as well as Bloomberg News reported yesterday that the country is considering a temporary halt on shipments and maritime activity that could violate the U.S. blockade. Though at the same time, Iranian state media did report last night that an Iranian supertanker made its way through the Strait of Hormuz, though that has yet to be confirmed by the U.S. Instead, we got a statement overnight from CENTCOM saying that all commercial traffic to and from Iranian ports has been halted. As we're getting more details, a U.S. official telling us that the military is stationing its vessels in the Gulf of Oman instead of directly near the strait in a bid to give the U.S. more flexibility. This blockade isn't the only means of pressure that the U.S. is looking to deploy ahead of potential dialogue, including the Washington Post now reporting that additional troops are being sent to the region and the U.S. Treasury threatening additional secondary sanctions on any financial institutions that aid the country. John, as you all know, this comes after yesterday the Treasury announced it was not renewing that 30-day waiver for purchases of Iranian crude already at sea. But I will point out that Bloomberg News is reporting new this morning that nearly 4 million of those barrels just arrived in India ahead of that waiver expiring. This after just yesterday, Indian Prime Minister Modi called President Trump about the war in Iran as we get these more headlines that the president has been speaking to world leaders about this, including breaking in the last few minutes. President Trump saying that China hasn't taken issue with the strait being closed so far.
Tyler Kendall with the latest in Washington. Tyler, thank you. Tyler's right. According to the president, China hasn't pushed back. The Saudis haven't pushed back. Moments ago, it's starting to sound like the Iranian military is pushing back.
Right, the Iranian military saying that the United States needs to get out of the blockade, and potentially what they have continuously said is there will be escalation because of this. They had said that if you block our ports, we are going to go after your partners' ports in the region as well.
To discuss, joining us now, Colonel Wayne Sanders, the Senior Defence Research Analyst at Bloomberg Intelligence. Colonel, welcome back to the programme, sir. How fragile is this ceasefire?
It's pretty fragile. I think if you look at the next 24 to 48 hours, Iran's responses are going to be key here. The first 24 hours in the blockade, I'm sure it's just Iran trying to be able to figure out where they can position forces necessary if they need to respond. And so I think a lot of the tell there is going to be on whether or not any of those strikes actually take place over the next 24 to 48 hours against some of the Gulf states, as well as U.S. military bases in that region as well.
Would Iran do this within the Gulf of Oman and the Strait of Hormuz, or would they actually try to get the Houthis involved in the Red Sea?
I think they could do either one. I think that if they get the Houthis involved, obviously it gives them a little more plausible deniability in the region. But when they keep things localized, if they're trying to keep it U.S. focused, they're trying to keep it against what we're doing on the blockade, then they're going to want to have some type of show of force against either U.S. or anybody that they're trying to escort through.
What do you make of the fact that the Pentagon, according to the Washington Post this morning, is sending 1,000 more troops to the region?
So, I mean, I think that one is obviously it's a leverage that that the president can use. But also on the military side, it could be to shore up additional boarding and interdiction teams, which could be part of the blockade. Seizure and inspection of vessels actually takes quite a few people to do that. The 11th and 13th Marine Expeditionary Units are very good at that. But if these are reinforcing of that, it might also be hardening bases in the region. So I think the real tell there is going to be what type of logistics follows along. If it is a lot of Army logistics, you might be looking at more of hardening of the U.S. bases in the region. It might also just be something along the lines of military Sea Lift Command, which are the ones who actually provide kind of a conveyor belt of resources and fuel and all that to the ships in the region. That could also be a play in this as well.
Colonel, I've seen a lot of commentary from different officials talking about who holds the cards. It seems like everyone's talking about that. Is it the U.S. holding the cards? Is it Iran holding more cards? What's your sense of the points of leverage right now heading into further negotiations at a time where we still pretty much seem to be at a stalemate?
Yeah, so the military normally looks at it. There are four levers of national power. You have diplomatic, information, military, and economic. So on the diplomatic side, both sides are trying to apply that same level of pressure to be able to do it. On the information campaign, I would say Iran normally does pretty well on that because of the asymmetric threat. They don't have to strike a whole lot. They just have to have something on fire to be able to create some chaos in the market and create chaos around the world. Militarily, the U.S. is dominated in that region, but the IRGC does have capability. And then economic, you've seen a lot of these pieces play out over the last month as well.
How much do you really see China playing a part in this? We know that President Trump was saying that China did not push back regarding the blockade. There are questions, and there have been reports about China supplying weaponry to Iran, potentially even a new air missile defense system. What's your sense of what the reality is and what's fiction?
Yeah, I find that very, very hard to believe, especially if you're talking about exquisite air defense systems, because these things aren't small, and the U.S. has eyes in and out of Iran pretty much across the board. So you're not going to see some large, aircraft coming in that's dropping off these types of supplies that's not going to require a U.S. response. So I think that's probably one of the biggest ones. I've seen other reports that are dealing with a lot more of the smaller shoulder-fired weapons, while I still think that's very risky for China to do, because if it is attributed back to them, and there is a lot of proof there, that obviously puts them in a worse position on the national stage. But if they are trying to smuggle those in, those smaller type weapons, those shoulder fire, Stinger type missiles and things of that nature, those types of weapons are small enough to be able to get through onesies and twosies, but you're not going to be able to put it together at the level of the air defense systems that some of the reporting is putting out there.
It's not just weaponry, though. The Financial Times this morning saying Iran used Chinese spy satellite imagery in these companies to target U.S. bases. At the same time, the president seems to be striking a more friendly tone with what Beijing is saying to Washington. How concerned are you about how much China is really helping Iran and targeting U.S. service members?
So, when it comes to China, I know we had that talk earlier about Russian intelligence, supporting Iran as well. I think part of it we all need to remember, too, is that a lot of that is dual use technology that could be tied to China's civilian side, as opposed to dealing with the Chinese People Liberation Army or the Ministry of State Security or anything like that from that perspective. So I think that it is definitely being leveraged. I think that Iran is going to use anything and everything they possibly can. And because of how good technology with satellites has become, even on the commercial or on the military side, it has allowed an advantage, a technological advantage for pretty much everyone to catch up somewhat to the technological advantage of the United States when it comes to satellite imagery.
Colonel, you're in a different seat to the seat that a lot of people on Wall Street are sitting in. They're focused on markets, and the comments coming from the president. It's an anticipatory asset class. Basically, they're seeing the president looking for an off-ramp. This market's moved on. What guides you, away from presidential statements, what guides you and your thoughts about how things are progressing?
I would probably say when I look at the military strikes against some of the Gulf state neighbors, that is something that has started to wind down, obviously, during the ceasefire. It went from 149 strikes the day before the ceasefire down to 7. You saw a handful of upticks a little bit during each of the times, but not to the same level that it had been for the first 4 months. So I think, 4 weeks. But what I continue to look at right now is some of the logistics tail, where we're actually going, the transition of the U.S. military into the types of weapons that they're using, and then at that point in time, also the response for some of the other folks in the region, the Gulf states that are playing a part in this and starting to put additional pressure. I think all of those are good telltale signs that things are moving in the right direction. But Iran having an asymmetric threat is always that card that they can play at that last second.
And that threat certainly still lingers. 4 weeks felt like 4 months, without a doubt. Colonel, thank you. Colonel Wayne Sanders there of Bloomberg Intelligence. And what guides him and how he's thinking about this war?
Yeah, and right now it seems like it's less bad news also on the geopolitical front. Things are not escalating or getting worse. And that's the reason why Wall Street is moving on. There are frictions, though, that are going to be long-lasting. And this really is the ultimate question. The Strait of Hormuz may never be open again the way that it used to be. What does that look like? And the fact that people have kind of moved on is notable given the potential inflationary pressures.
People have moved on, but we should note the shock in Asia is really getting very, very dire. Right now you have Pakistan that is dealing with controlled blackouts in the evening because they want to make sure they are controlling the price of electricity. For the first time ever this morning, India received Iranian crude barrels. Well, guess up. That waiver's ending, and this blockade means no more oil's coming
We've seen
through.
that rationing across Asia. It's been brutal for them, I know. Coming up on the programme, we'll catch up with Susan Bell of Rystad Energy with crude trading back below 100. Plus, Yahira joins us. She's got your morning movers. Broadcom rising on a new chip partnership with Meta. That stock is up by 2.5%. Live from New York City, you're watching Bloomberg TV. We are wrapping up quarterly bank earnings on Wall Street this morning. In about 15 minutes from now, we should hear from Bank of America, Brian Moynihan and the team. In the next hour, we should also hear from Morgan Stanley, Ted Pick and the team at 7:30 Eastern Time. Bramo catching up with Ted Pick later on this morning, so look out for that in the 10 o'clock hour, I believe, Lisa.
Yeah.
A little bit later this morning.
And really, the key questions that everyone has is how big is that pipeline? How much can capital markets remain open? The other interesting note is how much all of the executives have completely dismissed private credit concerns. They're all coming out and saying, ultimately, this is not systemic. We have it under control. I expect the same there. And then just going forward, how much are consumers really feeling the heat, given the fact that ultimately they had a lot of spending power going in and Americans like to spend?
Ted Pick catching up with Lisa later this morning. Don't miss that, 10:45 Eastern Time. Your equity market at the moment pulling back just a touch on the S&P 500, negative by a little more than 0.1%. On the Nasdaq, down by 0.2. What a run on the Nasdaq. 10 consecutive days of gains, the longest run since November 2021. That little bit of weakness this morning, some headlines moments ago from Iran pushing back on the blockade and really exposing just how fragile this ceasefire might be.
The Iranian military spokesman, according to Iranian state TV, is basically saying that this constitutes a breakage of the ceasefire terms. They also say if it continues, Iranian's armed forces, the IRGC, will not permit any exports or imports to continue through the Persian Gulf, the Sea of Oman, or the Red Sea. Basically saying we are going to go after all of these other parts of our proxy regime that have been dormant for the past 6 weeks.
That's boosting crude this morning, up by 1.8% on Brent, on WTI. Both of those contracts, the front end of the futures curve, closing below 100 for 5 consecutive days now. That's bringing this market just a little bit of comfort, but a boost from the headlines we've seen in the past 15 minutes. They're the scores. Let's get you some single names, some morning movers. Yahira has more. Morning, Yahira.
Hi, John. We start with Broadcom. Those shares are rising 2.6% as the company expands its partnership with Meta, building custom AI chips. It's part of a multi-billion-dollar effort to build out more than a gigawatt of computing power. And it speaks to something larger that we've been hearing from guests, that the AI build-out is alive and well. Deals still getting done. We keep hearing about them, even as this market grapples with the Middle East. We are also seeing shares of Nike moving higher in the pre-market, up 2.3% on a show of confidence from the top. Board director Tim Cook and CEO Elliott Hill buying the stock, putting about $1 million to work. It's a show of support as Nike goes through this rough stretch, but we've seen this type of buying before, and the stock is still down some 30% year to date. And we end on shares of Robinhood rising 4.25% after a big shift from the SEC, the agency approving changes that remove key limits on day trading, including that $25,000 minimum balance. So it's now easier for retail traders, retail investors to trade more actively, and that is a boon for the likes of Robinhood, since retail makes up such a large portion of its users. John?
Yahira, thank you. Thanks for the update. More from Yahira in about 15 minutes' time. On our radar this morning, President Donald Trump suggesting talks with Iran could resume this week. A ceasefire between the two nations expires next Wednesday. The president did not say if Vice President J.D. Vance would continue to lead negotiations. Elsewhere, the Treasury Secretary, Scott Bessent, saying the global tariff struck down by the Supreme Court could be reinstated.
We will be implementing or conducting Section 301 studies so that the tariff could be back in place at the previous level by beginning of July.
The president imposing a temporary 10% tariff following the High Court's decision. The levy set to expire July 24th. And finally, Anthropic drawing investor offers that could value the company at more than $800 billion. It's not clear if the AI startup will accept investor terms, Anthropic previously discussing a listing as early as October.
Yeah, in the last round of funding, Anthropic was valued at $350 billion. That gives you a sense of more than the doubling that this $800 billion valuation comes into play. And it comes after the Mythos experience that we all had, which I just want to add, it's really notable that after Anthropic came out and said, we're going to release something only to a couple people because it's so dangerous should it fall into the wrong hands. Guess who's doing the same thing? OpenAI. They're about to roll out something only to a few people because they too have something. Guess what? We too have something that could be dangerous. So watch out.
Right. So they come out with this thing that everyone wants their hands on. And now it's like, oh, wow, their valuation is so much higher. I find the U.S. government relationship with Anthropic right now fascinating. On one hand, they're fighting intensely with the DOD. And we had the Undersecretary Emil Michael on after he basically said that Dario Amadi had a God complex. Then the Treasury Secretary last night hailed what Anthropic was doing and calling it a revolutionary step that'll keep America ahead of China.
This industry has such a huge branding problem right now that they need to address. And it's exacerbated by the leaders in the positions that they are at the companies that you talked about. And I'm not sure what they're going to do about it between now and the IPO. I'm sure the kind of comments they make at the moment help increase the valuations of their firms going into those IPOs that people expect later this year. But it certainly doesn't help consumer attitudes, and I would say attitudes of the electorate at large towards these companies. And that could expose them further down the line when the people that represent those electorates will be setting the regulation around those companies and the taxes they'll have to pay as well.
Yeah, and not to tie too many things together, but this is also related to the recent disruption that we're seeing in energy markets because energy bills are already going up. And then if you think about how much electricity costs are going to go up for any regions that are tied to some of these big hyperscalers, that's going to become increasingly a political issue.
Let's turn back to the energy story. Crude rising after Iran warned the U.S. against continuing its naval blockade, saying it would violate the terms of the ceasefire. Susan Bell of Rystad Energy writing Hormuz will reopen. But the question is how much pain the market absorbs in the meantime. Susan joins us now for more. Susan, good morning and welcome to the studio.
Thank you so much.
Let's get into how much pain we're experiencing right now. Just describe what's happening in physical markets.
Well, the physical markets are extremely stressed, and I think, a lot of focus is on the ICE Brent price, but the ICE Brent price is a cash-settled market, right? It's not a physically settled market, and really, if you want to see what the pain is, look at dated Brent. And dated Brent premiums to ICE Brent are in the order of 25. Yesterday, the market closed with dated Brent at, I think, $30 higher than ICE Brent. So the true physical markets are extremely stressed.
Do you expect that to turn around anytime soon? Because this market, and when I say this market, this equity market has moved on really, really quickly.
Right. No, I don't. I mean, we really do need to see flows established out of the Strait of Hormuz before the physical markets can start to rebalance. I think the reason why the financial markets, so the crude oil financial markets have been relatively stable over the past couple of days is that we have yet to see Iran retaliate. Now, the U.S., the Pentagon yesterday said that they successfully blocked four vessels, or at least 4 vessels turned around on their command. But then there's conflicting news coming out of some of the ship tracking agencies that are saying, well, actually, there was one vessel that was loaded at an Iranian port that was able to get through the blockade. So, there's a lot of really conflicting information out there, and so far Iran has not retaliated. But the news this morning that they do intend to retaliate if their trade does get blocked, that would amp markets up all over again.
Let's say there isn't a massive escalation, that things kind of stay where they are for a number of weeks and then slowly get a little bit better. Yeah. Does it make sense to you that December dated contracts for Brent are at $82.49?
It does. If there is not a massive escalation and if the Strait of Hormuz takes its time to reopen, it does make sense that dated Brent or that the Brent contract is so elevated in December, because what's happening right now is we're digging a hole in inventories. And when the supply recovers, a lot of that volume has to go back into restocking, right? So it's not that we're going to see the markets collapse the minute we start to see flows coming out of the Strait of Hormuz.
I thought you were going to say that it should be a lot higher. So that was where I was kind of heading. So that's sort of one of the questions that people have. We're focused very much on the oil and the energy space. Is that the real disruption that you think is going to be truly problematic for the global economy? Or do you think that some of the other disruptions, whether it's agriculture, whether it's the metals sector, could be potentially worse?
I think that, energy it's almost a human right. And that is going to be the most painful impact of all of this. But I do believe that there is, if we don't start to see something happening in the ag space, the fact that fertilizers are so expensive and effectively unavailable for some nations because it's unaffordable, this could move into food scarcity. Which is very concerning.
Well, what about things like LPG, which India needs to cook every single meal?
Absolutely, and LPG is a significant issue, particularly for India. They had resolved their immediate concerns by negotiating transit for vessels through the Strait of Hormuz, and of course, the Trump administration is saying they are not going to block navigation for trade that is not tied to Iran. So India should still be able to get their LPG. But of course, if Iran retaliates, that upends everything. And if Iran retaliates and the Houthi get involved and start to impact that flow out of the Red Sea, that puts even more pressure on Asia because so much of their crude oil is coming from that direction now.
This morning, India actually got 4 million barrels from Iran from that general license that the Treasury had 3 weeks ago that they were unsanctioning Iranian oil at sea.
Yes.
How long does it take for a ship to go from the Strait of Hormuz to a port? Basically meaning if its blockade really started in earnest yesterday, when do you think we could see even more physical disruption?
So I think the average days of transit from the Strait of Hormuz into Asia is 15 to 20 days. It depends. I mean, if they're going all the way to China, it's longer. India, it would be shorter. Asia has already seen the fact that they're not getting any oil right now. There was oil on water through the first 25 days of March, but now there's no oil on water.
Susan, it's good to see you. Thanks for dropping by. It sounds like a doom and gloom conversation relative to the enthusiasm elsewhere in the stock market, but this is real. That's what's happening in physical markets right now.
Well, that's the reason why, as much as you feel doomy and gloomy, I think a lot of people are on the same page. It's just that markets are saying, what is the pain threshold in which the global economy can move on? And people are taking the most rosy scenario at face value.
Susan Bell there of Rystad Energy. Susan, thank you once again. This headline from AP just crossing that mediators are moving closer to extending the US-Iran ceasefire. That headline crossing just moments ago, that mediators are moving closer to extending the US-Iran ceasefire. Some conversation about that in the last week. We'll keep an eye on that. Crude still elevated, close to 97 on Brent. Earnings from Bank of America just around the corner. Before we get there, let's get you some top stories, some headlines with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump signaling he's ready to wind down the war with Iran. Trump telling U.S. news outlets that peace talks could resume in the next 2 days. The president saying Iran now has a different, less radical regime. A confirmation hearing has been set for President Donald Trump's nominee for Fed Chair. Kevin Warsh will face the Senate Banking Committee at 10 a.m. next Tuesday. Senator Tim Scott expects the DOJ to drop its investigation into the Fed's renovation project, clearing the way for Warsh to be confirmed. And Snap is laying off roughly 1,000 full-time employees, or 16% of its global workforce. In a memo to employees early this morning, the CEO said the cuts are necessary for Snap to boost efficiency and profitability. He also cited improvements in AI technology that let Snap employees move more quickly. That's your Bloomberg brief. John.
Yahara, thank you. Thanks for the update. Up next on the program, mixed results from the big banks.
There is still a lot of uncertainty out there, but should the hostilities in the Middle East start to die down and we get this resolved sometime in the second quarter, that points to a very healthy second half of the year for the banks.
In just a moment, we'll break down the results from Bank of America with David George of Baird. Plus, we'll get you the latest on a US-Iran ceasefire. AP reporting that they agree in principle on extending that truce. More on that headline and the latest results from Bank of America in just a moment. We've got two things to do here, the latest on Iran and the US, and then we'll break down the results from Bank of America as well. Let's start with the latest on the US and Iran. This from AP moments ago. They've given, in principle, an agreement to extend the truce. The latest from the US and Iran, according to AP just moments ago. So in the equity market, there were some very small losses. We've erased them. We're just about unchanged on the S&P 500. In the commodity market, there was a boost to Brent and to WTI. We've erased some of those gains. Brent crude down to about 96, WTI at 92. The truce set to expire in the next week or so, and this looks like the US and Iran is getting closer, in principle at least, to agreeing to extend it.
It's supposed to end on April 22nd, so we'll see how long that they're willing to, in this idea, in principle, extend that truce. It also comes at the time where the Pakistani Prime Minister has announced he will be making a visit this weekend to some Gulf countries like Saudi Arabia, Qatar, as well as Turkey. So for him to then go back to Islamabad, have consultations with these other mediators that have been trying to bring an end to the hostilities, this actually tracks and makes sense. It's interesting, though, this comes after the Iranian military said, if you are going to continue this blockade, we view that as essentially ending of the ceasefire, and we're going to go after some ports.
The market, I think it's fair to say, focusing on one of those headlines and not the other,
yes,
given the 10% move we've seen off the lows in the equity market. I mentioned the second piece of news we need to cover, results from Bank of America crossing just moments ago. That stock is up by 2% in the pre-market. With the latest, here's Danny for more. Hey, Danny.
Hey, John. It has a similar flavor, I must say, to Goldman Sachs. That is a big beat on equities and a really large number for equity trading, but a slight miss on FICC trading. So the numbers themselves, equities comes in at $2.83 billion. The expectation was just over $2.5 billion. That is a record quarter from Bank of America when it comes to equity trading, which means their overall trading numbers, a slight miss because of a miss on FICC, $6.3 billion. That still is a record quarter for trading. FICC comes in at $3.5 billion. The estimate was for $3.8 billion. So that is where we are seeing a miss in their trading numbers. But again, it reflects a really strong first quarter for all of Wall Street, given the volatility and the results on the trading desk. When it comes to their net interest income, that is a beat to $15.75 billion. The estimate was for $15.37 billion. It's something the company had been very optimistic about. Their co-president not that long ago was guiding towards at least 7% growth in net interest income. So we expected that to be a strong number. I would just flag what they're saying about credit. We've seen the banks, many of them for the first time, break out their private credit exposure. Bank of America, no exception in this regard, breaking out that they have $20 billion worth of exposure to private credit. That would actually put them in the smallest camp of all of the banks we've heard from so far. Just a reminder, Citi, $22 billion, Wells, $36 billion, JPMorgan, $50 billion. So Bank of America showing that they have less exposure to private credit than their banking peers. Finally, just some of the commentary we're getting from Brian Moynihan saying we remain watchful of evolving risks. However, we saw healthy client activity, including solid consumer spending and stable asset quality, indicating a resilient American economy. So something we've heard from other executives. Everything looks good for us, but there are evolving risks.
Danny, thank you. Thank you for the update. Hermes and LVMH have been beaten up in the last 24 hours, but if they've got a store near a Wall Street bank and this keeps up, I think they're going to be OK. The latest headline from Bank of America, record equity sales and trading revenue. Over at Goldman, we had a Wall Street record for equity trading revenue. Over at JPMorgan, traders posted their best ever quarterly revenue. At Citi, the highest quarterly trading call since the financial crisis. So these guys have been busy over the past 3 months.
Yeah, the volatility has been a good thing when it comes to their returns. You did see, as Danny was saying, Bank of America missed slightly on the fixed income currencies and commodities trading. Nonetheless, still coming in with $3.5 billion of revenue versus the expected $3.78 billion. The takeaway also, very much the consumer is solid and the U.S. economy is chugging along. At what point does the volatility that's fueling trading and sales potentially stymie the pipeline that has been fueling also record banking fees? And that is maybe a tension and maybe not as people look to a brighter future for at least banks.
Let's get to David George of Baird. David, welcome to the programme. You've seen the results from some of the big players. Can this keep up? And why aren't you as bullish as some on the street are on some of these names?
Good morning, John. Thanks for having me. Yeah, these numbers look pretty good. We're kind of just processing them as you are in real time here. But as you say, they look pretty good across the board. Capital markets was very strong. We had a lot of volatility in oil, gold, silver, and rates throughout the quarter. And obviously, B of A benefited from that, as did some of the other money centers. In terms of the stocks, there was a window to buy a couple of these maybe at the beginning of the war, and we upgraded a handful of the regional banks. during that period of time. But we still think that the risk-reward trade-off is better in some of these regional banks like a Huntington, Fifth Third, PNC, and Citizens, for example.
And we just did see PNC, for example, report earnings and raise their full-year net interest income estimate. I'm just wondering, have we put to bed some of the concerns about private credit? Danny was talking about how all the banks are breaking out their exposure. Bank of America came out with a relatively low exposure. Their net charge-offs are lower than expected. Is there sort of a waning in interest and concern about this area?
Yeah, it's really going to be headline dependent, but we've been of the view that market participants are maybe overly concerned, Lisa, as it relates to private credit. And again, I think it's important, and we heard this throughout the quarter, that the big guys and even some of the regionals were going to kind of size this private credit exposure to make market participants maybe a little more comfortable around the exposures and actually the actual size. And as these companies report, these are 1% to 2% of total loans. And again, Wells is almost a $2 trillion balance sheet. Same with B of A, and these are $20 to $30 billion loans. And again, the structures of these are also very low risk. So from our perspective, those fears are overblown. The bigger fear around credit is a function of how long does oil stay here? If oil is elevated for an extended period of time, it's a concern around the consumer potentially, as well as just how it makes its way into inflation and the impact on corporate profit margins.
David, just based on the big banks, not necessarily the regionals, and we still have Morgan Stanley yet to report, who's been the winner so far in your eyes?
Honestly, I'd say JPM and B of A probably had the best quarters. Obviously, as you mentioned, Wells had a tougher quarter. They reaffirmed the outlook for the full year, but they missed our pre-provision, which is basically kind of your pre-credit earnings number, by 4 to 5%. And I think it's also important to note that the stocks came in relatively hot. We have erased all of the war fear and losses going into earnings. So we've seen almost a 10 to 15% move in these stocks. So they came in a little hot, but we think that JP so far has had the best quarter. Excellent capital, excellent core trends, and a great outlook as well.
David, always great to hear from you, and thanks for making time for us. I know how busy you are on a morning like this morning. David George there of Baird breaking down the latest results. This is what we're seeing in Bank of America. I'm very interested in how the consumer's doing right now. We've heard from a range of banks that everything's okay. Just to break out the details from B of A, consumer banking up 21%, payments up 5%, consumer credit debit spend up 7%, deposits are up, loans have grown. When you look across the bank right now, that speaks to an economy that's still doing well, better than okay. And I'd say we've heard that on repeat from several banks across Wall Street over the last week.
And even when they've gotten pushback from analysts saying, what about higher gasoline prices that offset the one big beautiful bill and any kind of tax refund that people get? What they've all said, led by Jamie Dimon, is they can absorb this and then some. And what you just saw in the Citigroup consumer spending pulse, again, just really strong across the board with an expectation that even retail will start to do better.
Yeah, Brian Moynihan saying he sees a resilient American economy. They all continue to say that. What's going on in gasoline prices, potentially trickle-down effects of diesel when it comes to other products like your food, is not hitting the consumer right now, or the consumer at least is able to make these decisions and weather the storm.
Stock is positive in the pre-market by some 0.6%. One more bank to go, Morgan Stanley, in the next hour. So far, so good, though, for Wall Street. Bank earnings are fine, based on what we've heard so far. On top of that, we're looking at extending a truce between the US and Iran, based on the headlines from AP just moments ago.
The more you can take the temperature down and put that in the rearview mirror, the more people will focus on how good earnings are. And so far, so good, as you said, with respect to both the outlook as well as the read on the American consumer.
Up next on the programme, we'll catch up with Abramowicz of Citi, Ed Mills of Raymond James, Gerard Cassidy of RBC, and George Wonderlin of Schroders Capital from New York City this morning. Good morning. The second hour of Bloomberg Surveillance. Up next.
There is scope for inflation to go higher.
Base case is that you'll stay around 3%.
We in the markets accept that a 2% inflation target is a myth.
There are cracks in this economy. There's some other kinds of tailwinds that are holding things up.
Longer term, things have been quite stable.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. The scores, the price action looks like this. Equity futures just about unchanged on the S&P 500, within 1% of all-time highs on the S&P 500, following a 10% rally off the lows on the S&P. 10 days of gains on the Nasdaq, a 10-day winning run, the longest since 2021. In the crude market, with 10% moves on equities off the lows, we've had 20% moves off the highs on crude. Brent this morning at 96, WTI at 92. A report from AP that the US and Iran is close to extending this truce.
Yeah, which would be a balm to the ears of so many people on Wall Street who already have declared mission accomplished. Ultimately, it would indicate that kicking the can down the road means no further escalation, at least not in the near term. And that's part of the reason why people have moved on and looked to earnings, which have been pretty good. Actually, they've been better than pretty good. And looking to the tech investments that, once again, seems to be the ballast to this economy.
This report signals that they want this, kicking the can down the road, keep the détente. Right now, living in almost purgatory, no fighting, but no true peace. If you look more into the AP report, though, there is one official speaking to the AP that says before the ceasefire ends on April 22nd, 3 main sticking points they want to get through. What are those 3 main sticking points? Oh, Iran's nuclear deal, the Strait of Hormuz, and wartime damages. None of that is going to happen before April 22nd.
Stop spoiling the stock party. That's how people feel this morning, just as you speak.
I'm getting a lot of panicking messages from people like Neil Dutta.
Look, in fairness to you, that is what's happening in the physical oil market. The Strait of Hormuz is still largely closed. Physical prices, there are shortages across Asia. We're seeing them build. The Europeans are worried because they've had their last deliveries of some oil products and they know that nothing is coming yet. And there is this hope that in the future it will. And this market continues to take comfort from the shape of the futures curve and how depressed prices are looking further out.
I just find it challenging when Pakistan literally overnight is they're suspending electricity supply for about 2 hours every single day. In Asia, you have individuals who are not going out to work. The government is saying you need to stay home. What you described, what's happening in Europe, they know that they're on the edge of their last products being delivered, especially things like jet fuel. And they're having meetings because they need to do something because consumers are very angry. We're a little bit more insulated here. And I think the market also takes comfort that the President of the United States at least is signaling this is the direction of travel he wants. He wants an off-ramp.
Right now, we're looking at earnings as well. Bank of America in the pre-market higher by 0.9% in early trading. Every bank we've looked at, Goldman, record trading call. Trading records over at JPMorgan at Citi. More of the same from Bank of America. That name up 1%.
You could tie these stories together. Why is the market so sanguine at a time of some potential real pain in the physical commodities market? Because this market is awash with liquidity. Capital markets are wide open. People are getting deals done. And Bank of America, Citi, Goldman, JPMorgan, all minting money. And that is really the story. And frankly, that is the underpinning story of the strength in a U.S. economic story that's tied to artificial intelligence and consumers that still have jobs and still have money.
Morgan Stanley reporting later this hour. We should get those results around 7:30 Eastern time, so look out for that. Coming up this hour, we'll also catch up with Beata Manthe of Citi, with stocks within 1% of record highs. We'll speak to Ed Mills of Raymond James as the U.S. pushes for a grand bargain with Iran, and Joe Cassidy of RBC as Morgan Stanley closes out big bank earnings on Wall Street. We'll begin this hour with stocks nearing all-time highs. Beata Manthe of Citi with a year-end S&P 500 target of 7,700, upgrading U.S. equities to overweight on a, quote, quality defensive tilt. Beata joins us now for more. Beata, good to see you. Welcome to New York. Welcome to the studio. It's fantastic to have you with us.
Great to be here.
Let's get into this call. Overweight U.S. equities. What's underpinning that?
So we've been advocates of the diversification away from the US for over a year. And of course, that was based on the broadening of the EPS coming from broad set of sectors, more cyclically driven. And that's this assumption and what we've been seeing in the data was telling us this would continue into this year. And of course, the war has happened. And with markets almost at all-time highs, and it's not only S&P, it's more cyclical markets like Europe as well, you have to step back and ask yourself, has anything changed? Even if the war finishes today, which of course it won't, has there been other damage done to the economy, or is going to just trickle through damage to consumer? And your assumption right now should be for estimates for cyclical earnings are most likely too high. So we expect some downgrades there. And in the world where downgrades are coming through or will come through, you look to the parts of the market that are upgrading. And that's the US. But again, the US is upgrading through a very different set of sectors. And it's tech again. It's mega cap tech. So AI that was on the shaky ground at the start of the year is back because it's derated and earnings are getting upgraded. That's why.
I give you credit where it's due because you were quite early on the international call at the time, so credit to you and the team for doing that. US leadership appears to be reasserting itself because of the tech story, but we're seeing that in other places too. South Korea, the Kospi is absolutely flying again. Do you have less enthusiasm for the international tech trade? How are you thinking about that dimension?
So you could argue that the international tech trade is more cyclical. I get that, but they are all interconnected. And Korean market, it's something insane. I've never seen anything like that. Every single week, the upgrades to the earnings for Korea are amounting to like 20% extra in the EPS. The earnings expectations have tripled. They are up 300% over the past few months. So for me, again, coming back to the yes point, in the market where the outlook is uncertain for many parts now, you just follow the earnings, right?
What's fascinating is people are saying it's back to the U.S. and the U.S. seems to be the winner. You're not seeing a commensurate move in the dollar. And actually, now a lot of strategists are coming out and saying they expect a reassertion of the weakening in the dollar that we saw earlier this year. How does that play into a U.S. call when catering to European investors?
So our view is that in this current market environment, you have to be very nimble. So what is winning right now, in a few months' time, could be reversing as well. Because the drivers for the diversification trade are there underneath, right? But they are just overshadowed by other worries right now. And US dollar weakness, of course, that would be very helpful. US usually doesn't outperform in the dollar weakness environment. So that's something to watch out for, but that's really very dependent on the resolution of the war and the speed of that resolution.
I've heard a lot of people say this, stay nimble. What does that mean in terms of the liquidity profile of your portfolio, how much you have to stay in the names that are easiest to trade, the assets that are easiest to trade, given the fact that everyone is expecting potential shifts that could potentially require some pretty significant trade activity?
That's a very important question. And of course, at the start of the year or late last year, everybody was getting excited about mid-caps outperforming, growth prospects getting better. But for us right now, this type of environment, you just stay in large caps, you stay in liquidity.
You say follow the earnings. Commodity strategists I talk to will say follow the barrels, the physical barrels.
Yeah.
What is the tension like right now between, say, your team versus the commodities team?
So our views are pretty much aligned, I have to say. So at the very start of the conflict, what we've done, we've upgraded one of the biggest geopolitical hedges, the UK, to overweight. We've downgraded one region that was very bullish, and we've had it as an overweight to underweight Japan. So the difference this time around versus 2022 is back then it was only about Europe, the energy crisis. Right now it is much broader. And Europe, what there could be physical shortages, but Asia is much more exposed to that.
Do you think the president has also basically primed the market for this because of all the job butting he's done and past episodes like Liberation Day?
Well, it's hard to say, right? What I can say is what I see in the data, and the fact that the situation is still very uncertain, and we do not have the edge on the outcome or the speed of the resolution to the conflict.
How different are the conversations with clients that you're having in Europe compared to the conversations you've had so far in New York?
So we get no pushback on the overweight of the US.
I'm not surprised.
Of course, everybody is still quite bullish, the emerging markets tech-related part. And of course, about Europe, investors are worried about longer-term effects of this energy crisis. They should be more limited than last time around in 2022, but there will be some, right? And of course, right now, investors are more upbeat, but our view is that lots of the majority of the market moves over the last week, the squeeze higher, has been because of the short covering. So the market was very, very well hedged, but underneath the surface, most investors outside the hedging, have been keeping the same winners as they've had selected for the start of the year. And that could be a problem once the positioning washes itself out.
Beata, it's good to see you. Thanks for the update. Thanks for being here. We should do it again soon. Thank you. Beata Matthew there at Citi. You're starting to start fights with the commodity team over at Citi. Max is joining us later.
Well, I'm just curious because the note leads in with, well, the commodity team says this. So, you know.
Max Layton of Citi joining us from the commodity team in about an hour from now.
Yeah, what I thought Beata said that was actually really interesting is that there is no disagreement, that you can have two things at once. You can walk and chew gum at the same time. I got that expression right. But this idea that going forward,
two for two.
I'm just absolutely crushing. I'm not going to say any more expressions. But going forward, there is a sense that even if oil prices remain elevated, you could still see strength coming from tech, coming from the consumer.
Let's give you an update on news elsewhere. With your Bloomberg brief, Yahara joins us with more. Hey, Yahara.
Hi, John. Mediators between the U.S. and Iran are moving closer to extending the ongoing ceasefire before it expires next week. The AP reporting Washington and Tehran had given a, quote, in-principle agreement to extend the truce, allowing for more diplomacy. We are seeing shares of Bank of America rising more than 1% in the pre-market after exceeding estimates for the first quarter. The bank reporting record equity sales and trading revenue. CEO Brian Moynihan remains watchful of evolving risks, but saying the results are, quote, indicating a resilient American economy. And U.S. Treasury Secretary Scott Bessent warning that China's trade surplus threatens global economic stability. At an Institute of International Finance event in Washington, he said the world cannot take a China with a $1 trillion surplus. That's your Bloomberg Brief. John.
Hey, Yahara, thank you for the update. Up next on the program, pushing for a grand bargain.
What the president wants to make, he doesn't want to make like a small deal. He wants to make the grand bargain. He said, if you guys commit to not having a nuclear weapon, we are going to make Iran thrive.
Up next, Ed Mills of Raymond James, live from New York City this morning. Good morning. Equity futures right now just turning positive on the S&P 500 following a close to record-breaking run. Very close, within 1% on the S&P 500 and getting even closer with the gains of yesterday. A 10-day run on the Nasdaq, just unreal. A 10% rally on the S&P 500. The Nasdaq 100 this morning just about unchanged. More bank earnings just around the corner. We'll hear from Morgan Stanley in the next 15 minutes. Crude looks like this. WTI and Brent shaping up as follows. Brent crude at 96, WTI at 92. Slightly elevated this morning, up by a little more than 1%. But some encouraging headlines coming from AP suggesting we're getting closer to extending a truce between the U.S. and Iran.
And that's enough. At least it's less bad news, and it's not necessarily some sort of escalation. I love this idea that less bad news is good news for this market, and everyone would like to move on.
So we go back to old stories.
Please.
The old stories that we love to go back to. The future of the Federal Reserve. I almost don't want to do this because we've done this so many times, but this from the president just moments ago, that Chair Powell will be fired if he doesn't leave on time. So let's set the stage. What does on time actually mean? I think we need to talk about that. His term as chair expires in the next month or so. But if Kevin Warsh is not appointed and confirmed in time, there is reason to believe the chairman will hang around. Is that on time? If the DOJ investigation wraps up, the Federal Reserve Chair Jay Powell has talked about maybe walking away, but hasn't totally ruled out staying on the board as governor. So does that mean he's staying beyond his time? I'd like a slightly firmer definition of what the president is talking about here and just exactly what he's looking to pursue.
And maybe at a later date, he'll give us that time frame. He also said that President Trump said that he was not planning to drop the probe on Fed Chair Jay Powell, and going on to say that he'll be fired if he doesn't leave on time. This goes as the hearing is set for next week. Really key question, though, about whether it will actually go through, given the fact that Tom Tillis very much is digging in his heels and saying until this probe is completed, he's not going to allow this vote to go through.
I'm with Jonathan. I'm struggling with the timing of this, and you. Okay, his chairmanship ends basically in a month, May 15th, 2026. But his governorship ends January 31st, 2028. So the president says he needs to leave on time. Is he talking about his chair or his governorship? Because that's a big difference.
That's very odd, isn't it? Look, you've got Kevin Warsh ultimately lined up to have a hearing. in the next week, I believe on Tuesday, on April 21. He's got pretty broad-based support in the Senate to get confirmed. He's got support from establishment figures like Jamie Dimon of JPMorgan. We talked about the support for Kevin Warsh elsewhere. So you've got your man, and he's ready to be confirmed. Yet you want to go forward with something that could prevent his confirmation. I just find the whole thing a bit strange right now. The off-ramp was there for you, and it hasn't been taken.
And not only that, but we hear about investigators trying to raid the new Fed building to get more information and getting turned away by security. I mean, it is increasingly becoming an unnecessary drama, and I am editorializing, but a lot of people in markets have already looked on from this too, because they want to look on from everything that is dramatic in any capacity and could potentially derail things. But right now, people are looking to a new Fed that we still don't understand the contours of, and we don't know when Kevin Warsh will actually get through, because both sides seem to be digging in their heels.
Tyler Kendall is down in Washington, D.C. Tyler, we were going to come to you on the war, of course, but this takes centre stage now. Your thoughts on what the president is getting at here and what it means for Kevin Warsh's ultimate confirmation hearing we've been waiting for over the last several weeks?
Well, John, it's clear that President Trump is trying to ramp up the pressure, but we have to keep in mind there's sort of two parallel things happening here. President Trump, of course, no secret that he's unhappy with Chair Powell, but it comes on the heels of yesterday, Chair Tim Scott saying that there is going to be this hearing in the Senate Banking Committee next week. But he also said that he is expecting that legal matter against Jerome Powell to be wrapped up quickly. And that's really what this all comes down to, because as you're discussing at this point, Senator Thom Tillis has been digging in his heels to block this nomination, despite saying a few weeks ago that he met with Warsh. He likes him. He wants to vote for him, but he does hold that pivotal key swing vote on the Senate Banking Committee. Republicans only have that 13-11 majority, which means that at this point, he really can block it. And importantly, it had appeared that the administration was given a potential off-ramp. After a few weeks ago, we saw this judge strike down the subpoenas that were issued against the Federal Reserve, saying that there weren't the correct grounds to actually issue them. However, at this point, the Department of Justice has been digging in its heels, saying that it's going to appeal that decision. And that is really what we have to look out for. As Tim Scott says, at least, he thinks that this could be wrapped up quickly.
Well, this could get very messy. So, Tyler, thank you. The latest from the president then, speaking to Fox News. These headlines just been released. The chairman, Powell, will be fired if he doesn't leave on time. Ed Mills of Raymond James, over to you, sir. Good morning.
Morning.
Good to see you. Your reaction to that headline. Where is this going with this Federal Reserve?
So there's a couple things that we have to watch. One, the Supreme Court's probably going to tell him pretty quickly that he does not have the authority to fire a Fed governor because he's already tried to fire someone, Dr. Elisa Cook. And I think if you take a step back, what he has done is ultimately going to make the Fed more independent. If he didn't do anything, these threats actually could have meant something. And now he can threaten, and it's probably going to make Powell stay longer if he is going to be threatened to kind of get fired for leaving on time. And then we go to Thom Tillis. He's really important. It's 13-11 on the Banking Committee. It will be 12-12. But we also have to remember, you don't actually have to have an affirmative vote in committee to be considered on the floor of the Senate. All that's required is the Senate Majority Leader has to file a discharge petition. If you have 51 votes, or 50 plus the Vice President, you can confirm someone. So, yes, he'll dig in his heels. This could add to the drama, but it doesn't stop Kevin Warsh from being confirmed if the Senate Majority Leader and 51 members of the Senate want him confirmed. So that's why the base case remains Kevin Warsh will be in the job sooner rather than later.
May 16th?
Around then. I mean, we still have a month here. We got all of the financial forms. All of the forms are now filed yesterday. Kind of the paperwork is done. Now it's time for a confirmation hearing. That goes well. You just bring it to the floor, prioritize this. He's confirmed.
Okay, so then what happens when the president says the Fed chair doesn't leave on time? He's going to be fired. Do you think the president means his chairmanship or his governorship, which ends in 2028?
Yeah, it's a good question, because if you look at the Federal Reserve Act, there isn't anything related to firing the chair. There is about firing governors for cause. And so you could make the case that the chair could be fired and that role, but the individual governor is going to be decided by the Supreme Court. Ultimately, the other thing we'd look at, and this is what we've seen in the past, is that the FOMC actually chooses its own chair. So the president could fire him as chair of the Fed, but the FOMC would then pretty quickly reaffirm him as chair of the policy-making decisions related to monetary policy, which is what the market actually really cares about, Annmarie.
Is this an ego issue, or is this an issue of trying to get interest rates lower?
I think it's a combination. I think this is just a pattern. You asked, like, why do we do this? He had an off-ramp. He didn't take it. How many times have we said it was right there, and then he did something that made it harder to actually happen? So this here is, I think, a pattern. I know that he wants this to be confirmed. I think that they could have confirmed him earlier than kind of the May 15th and maybe pushed him on. We've had the DOJ show up at the Fed, as we saw. The Fed didn't let him in. And so anytime that there is a conflict between, like, you don't let my guys do what I want them to do, you don't get to dictate that, I get to dictate that. I think this is behind that. I think he's seeing some of these stories that the Federal Reserve police force didn't let his folks in, and he's going to kind of establish this as, I'm the one in charge.
From a market's perspective, it's popcorn, watch this in your free time, but it has no relevance to anything unless it starts to increase some of the pressure on Kevin Warsh, should he get confirmed, to lower rates in the face of inflation that is somewhat higher and a really resistant Fed board that has pushed back significantly. So at what point does it enter the market's frame in some sort of relevant point other than just popcorn?
Yeah, so two things I'd say. The market always tests the new Fed chair. And we're going to see kind of that in rates more than, kind of the equity markets. But obviously that spills over to the equity markets. The conversation is going to be about the Fed balance sheet. Is he going to force that to be, shrunk? Number two, I think that Scott Bessent provided Warsh with a huge amount of political cover this week, saying maybe it's not the time to cut rates. So next week in his confirmation hearing, as kind of Democratic senators are going to say, are you going to do the president's bidding, and are you going to cut rates even if inflation is higher, even in the face of this war? It's like, look, I'm going to look what the data is. There is a debate about this. Even the Treasury Secretary said maybe it's not the time just yet. So we will see. I think the market has taken out the price, kind of the cuts for this year, pushed it into next year. I think that is now the base case. Thankfully, he'll have that political cover as he's debating this in the Senate Banking Committee next week.
Ed, you mentioned the fact that U.S. prosecutors made this surprise visit to the Fed. The market doesn't seem to care about that at all. If that happened in a country like Turkey, it would be a massive deal. Why is it not a big deal here?
Because it's a continuation of a story that most have decided is not a story.
Right. Doesn't matter.
No. I mean, we are talking about a renovation of a building. Anyone who walks by or drives by have seen a construction project there that is massive for years. We recognize that there are constraints on the way in which these are built. The Federal Reserve Act kind of dictates the number of buildings that the Fed is allowed to have, which drives up these construction costs. And so to the extent that this is about monetary policy, that would be a bigger deal. But if it's over a construction project,
some marble.
Yeah, it's very expensive marble.
I'll make it super, super simple. The biggest difference between Turkey and the United States. When Erdogan says you're fired, you're fired. In the United States, when you say you're fired, you're not. We have institutions. For all those no king protests that take place in this country, there aren't any. These institutions stand up and protect the laws that we have in this country. And that's why when the president says you're fired, they're not. It's different here.
And if anything, the independence, as Ed was just talking about, is only edified given the fact that Lisa Cook is still there, even after the attempts to fire her. And that is what people have been watching. So given all of that, is this a non-story increasingly for Wall Street, given the fact that ultimately Kevin Warsh will take over and he is completely acceptable? And this is all just popcorn.
Powell stand around is not a non-story.
That's true.
I think that's a pretty interesting one.
Right.
That's the dimension of this that is intriguing. Ed, it's good to see you. Thank you, sir.
Likewise.
Thank you. Ed Mills there of Raymond James. Up next, Jared Cassidy of RBC. Earnings from Morgan Stanley just around the corner. Stocks just about unchanged on the S&P 500. On the Nasdaq, after a 10-day run of gains, just stalling out, just a touch. We're going nowhere this morning. So far on the Nasdaq 100, the longest daily winning streak going back to 2021. More bank earnings on deck. Just heard from Morgan Stanley moments ago. It's fair to say they got it done. Morgan Stanley in the pre-market up by 1%. With the results, Danny Berger has more. Hey, Danny.
John, it is another monster quarter for another bank when it comes to equity trading. This is a huge number for Morgan Stanley. The estimate was at 4.6 $5.78 billion. It comes in at $5.15 billion. Just to put it in context, they are just inches away from Goldman Sachs' equity trading business, which came in at $5.33 billion, which set a new high watermark for the entirety of Wall Street. So Morgan Stanley just behind them. When it comes to their FICC trading, also a beat, which again, Goldman Sachs was unable to do this time around. $3.36 billion is where they stand for FICC trading. The estimate was for just under $3 billion. Net interest income, that's a slight beat as well. And their investment bank, that also beating with the return of M&A in the first quarter. And then there's the crown jewel of Morgan Stanley, and that is their wealth management business. That net revenue also coming in at a beat, $8.5 billion. The estimate was for just over $8.4 billion. So clearly, there's still lots of appetite among high net worth individuals and wealth clients to invest in these volatile times. Just a few sore notes and maybe why you're not seeing shares up as much as others. Their compensation expenses were higher, $8.5 billion. That was higher than expected. The bank just noting that they had a lot of bonuses to pay out, and that led into those higher compensation expenses. The provisions for credit losses, this might get a few eyeballs. That's higher than expected. $98 million. The expectation was for $80 million. And again, their non-interest expenses, that also comes in a little bit higher. So higher credit provisions, higher expenses, but everything else, very strong beats, John.
Strong across the board. Beat, beat, beat. Said this a few times already this week across major banks. These individual trading records we've seen at Goldman, at Morgan Stanley, at Citi, JPMorgan, Bank of America, they continue. Bank of America, OK, earlier on this morning, record revenue for them in some cases over in the trading division. Morgan Stanley this morning doing better, up by 0.5% in the pre-market. Ted Pitt coming up later. Look out for this, 10:45 Eastern Time on Bloomberg TV, catching up with Bramo on a solid set of results.
Yeah, I saw these results and I thought, no wonder he wants to talk. This is a pretty incredible quarter, and it talks to the strength that we've seen pretty much across Wall Street. A key question here is how much momentum is there heading into the rest of the year? Danny was talking about credit losses, the provisions for credit losses. How much is this tied to private credit? Have we put that completely to bed? It seems like everyone's just sort of casting some cold water over that. But otherwise, I mean, what Abramowicz was talking about, the idea that they're all trying to stay in liquid assets to keep trading and keep trading, well, that is music to the ears of Wall Street, because that trading, ongoing volumes have really supported a lot of these bank books across the board.
Stock is up by 1.2%. To extend the conversation, Jared Cassidy of RBC joins us now for more. Jared, welcome back to the programme. This line from Ted Pitt of Morgan Stanley. Strong execution resulted in net revenue of $20.6 billion. That word, execution. Jared, what's the difference between a great environment that benefits everyone and really fantastic execution? Are you seeing one or the other?
John, thank you for having me back. And you're right, execution is critical. As you know, all of these players are major players in trading, whether it's Goldman Sachs, Citigroup, JPMorgan, and of course, Morgan Stanley and Bank of America. However, you need to be able to execute for your clients, and Morgan Stanley, particularly in equities, has over the years done a very good job. And under the leadership of Ted Pitt, they're continuing with that. Now, the market conditions were wonderful for all of these players, as you pointed out, and volatility helps trading, and we saw that in spades with Morgan Stanley as well as the others.
Jared, based on your calls, and I'm just basing this on your calls, and I'm going through them bank by bank, you've got outperform ratings on JPMorgan, Bank of America and Citi. You've got sector perform on Goldman Sachs and Morgan Stanley. The numbers from Goldman and Morgan Stanley were great this quarter, great last quarter. Is there something about the backdrop for those two names that you don't think will be as supportive in the months to come?
Not somewhat. Yeah, that's a good point. I would say that there's the volatility and the impact on the investment banking results that we're trying to assess. We also know that those names are trading at valuations that are far superior to a Bank of America or a Citigroup, of course. And there's maybe better upside, we think, in owning those names rather than the pure plays on investment banking. But if one believes that the volatility will continue, that's a positive, of course, for trading. So every investor has their best pick in this capital markets business. And I can understand why some people may want to own Morgan Stanley or Goldman. We just prefer to go with the universal banks as the play.
It seems like Morgan Stanley and Goldman Sachs are frequently lumped together. That's been how it has been classically. They are rivals. Who do you think's winning between them?
That's a good question, because Both of them are really good in their different areas. Obviously, Goldman stands out in the advisory business. They're number one. They also are very strong in ECM. Morgan Stanley stands out in their wealth management business. One of the hallmarks of James Gorman, the former CEO of Morgan Stanley, was to move the revenues from the wealth management business from, if I recall correctly, during the financial crisis, less than 10% of total revenues to today over 50%. And that's really what's differentiated Morgan Stanley from Goldman Sachs, as well as their execution in equity trading as well.
Just curious, Gerard, we're hearing a lot from banks about potential risks going forward as they report these record hauls for the first quarter. I'm just wondering what you want to hear, what you have heard about the road ahead and the questions that remain to really assess whether this backdrop can really continue to persist.
It is a really good question, because the uncertainty created by the hostilities in the Middle East is really the number one question. You know, when will they end? When will the price of oil come down to more reasonable levels? And when we can get our arms around that with some confidence, I think that's going to really propel the banks as a group to higher levels because of the health of the U.S. economy, and also would potentially help the wealth management business as well as investment banking. That's one thing we've heard, is that, you know, the IPO calendar is still very strong, but due to this volatility, it hasn't really taken off yet, and people are very anxious to start to see that happen.
One big cloud that's hung over the banking sector has been private credit. Have we put those fears to rest, given some of the commentary and the loan loss provisions from the big banks?
I don't know if we'll ever put them to rest, but have they certainly been kind of tamped down? The answer is yes. You know, the banks were very good at disclosing how they structured these loans into the private credit sector. We are with what Jamie Dimon has said from JPMorgan, that during a credit cycle, you will see losses in private credit. It's not going to be systemic, in our opinion, which we agree with his view on that as well. But there will be losses, and there may be some spillover into the banks, but it will be manageable. The way they've structured their lending into the private credit sector gives them protection that enables them maybe not to have the losses that some people expect.
Gerard, before you go, and I know we've touched on this a few times already this year, but I think it's worth reflecting on once again. This year, we could see some of the biggest IPOs ever that we've ever seen in the history of capital markets, financial markets in the US or anywhere for that matter. We just put out a story early on this morning about Anthropic being valued potentially at close to $800 billion, and maybe, who knows where we end the year, maybe north of that. Jared, that's just the IPOs. Then the M&A. We had a story out yesterday, the team here at Bloomberg, that American Airlines and United Airlines were exploring a get-together driven by Scott Kirby. Now, Jed, I don't expect you to comment on that directly, but I just wonder what on earth we're opening the door to in the back half of 26 for all this activity these banks might benefit from.
John, you said it very well. And I would say that if we could, again, have the Middle East situation in a rearview mirror, and maybe that'll never happen completely, but certainly die down from what we're seeing. With this administration, they are very supportive of consolidation, deregulation, not just in the banking industry, but in many industries. And people know that this administration effectively ends at the end of 28. So we have a 2 to 2.5 year window to get stuff done. And to your point, I think these markets are going to be very robust to have a lot of that activity take place in the second half of the year, which will benefit, of course, investors and shareholders of these companies.
How well priced do you think that story is already?
That's a tough one. It's a fair question. And I would say that it's definitely not fully priced in, but there is certainly some of it being priced in, and it's because of the uncertainty. I keep on coming back to this with the Middle East, but that is certainly what's weighing on it. Once that is removed or reduced dramatically, boy, oh boy, you could see stocks even move further to the upside.
Jared, it's good to see you. Thank you, sir. Jared Cassidy there of RBC, wrapping up the bank earnings on Wall Street. I remember a conversation that we had with Brian Moynihan under the Biden administration, where some clients were even having a conversation about putting a deal together because they didn't know what would get approved under that administration. We were talking about handbags. You mentioned that. Coach couldn't even get that deal done. It was ridiculous.
Middle luxury.
Crazy stuff. Now we're talking about the opposite end of crazy. the potential of United American Airlines getting together. That is unbelievable. And Jared's talking about a 2-year window here, and companies that are going to rush to get things done that might not be able to get things done in a few years' time.
Which is why pipelines have not really shrunk considerably at a lot of these banks. That's a commentary that we've heard from a lot of the executives at the big banks, and why people are still expecting a banner year. And just as long as we can get this Iran thing resolved, that people can all get going again. And that's kind of been the story from the C-suite.
Yeah, this little thing.
This little thing.
This tiny little thing.
Yeah.
Danny's still with us. Danny, I wanted to give you the final words. Great work, by the way, over the past few days, breaking down these results. What have we learned looking at the results from Wall Street over the past 3 months?
I think we've just learned that when it's the right type of volatility, this is the type of numbers we get. Basically, every bank we heard from on their equity trading front hit a new record, setting new records for Wall Street. That will raise questions about where we go from here. This is something that Jamie Dimon addressed yesterday on both the investor and the media call, that you can't necessarily read forward this quarter in trading specifically in quarters to come. There's plenty of still volatility out there with a war ongoing, still questions over AI, so they could repeat this. But just this morning, a report came out from S&P saying that increasingly banks' trading exposure is fragile, given just how much they are dependent on some of the high-frequency traders. What happens if that pillar starts to collapse? So yes, the numbers are good, and it is worth celebrating, and you see Morgan Stanley stock up 2%. But again, between that and M&A, the questions will be asked, can they repeat such a banner quarter again this year?
Danny, thank you. Once again, looking forward to your coverage later on this morning. Looking forward to this as well, 10:45 Eastern Time. Lisa, catching up with Ted Pick, the Morgan Stanley CEO, a little bit later this morning. What are the questions for you now, after you've seen these results for this man right there?
Well, the main question, as we were just hearing, really is the outlook for the pipeline, given what is going on with that little thing over in Iran, right? It's this idea of how much is that really torpedoing people's plans, how quickly people will get back on board, what potentially rates staying at this level does to all of these deals, considering the fact that people had been expecting rates to continue to go down. And then, honestly, one of the key questions has been acquisitions, right? I mean, Morgan Stanley has been an acquirer and a disruptor. How much are they considering exploring the backdrop that seems to be an open door?
Like Goldman Sachs.
Exactly.
You know, like, why not? I'm not starting rumors. Don't run with that.
That would be similar, though, to the United American Airlines. You know, that would be a great flex.
Crazy.
Go ahead.
Morgan Stanley, no. I'm not starting anything.
You can.
Stock's up by 2%. Let's get you an update on stories. Ask him on stories elsewhere. Your Bloomberg brief with Yahira. Hey, Yahira.
Hi, John. Taking another look at those Morgan Stanley earnings, shares are rising 2%. The investment bank reporting equity sales and trading revenue for the first quarter well above estimates at $5.1 billion. Fixed sales also topping estimates, along with a beat on net interest income. Lisa will be sitting down with Morgan Stanley CEO Ted Pick exclusively at 10:45 a.m. this morning. The Pentagon reportedly sending thousands of additional troops into the Middle East over the coming days. According to the Washington Post, the reinforcements will include about 6,000 troops via aircraft carrier and over 4,000 Marines that are expected to arrive towards the end of the month. This coming as President Trump is suggesting the war is, quote, close to over. And President Trump warning Fed Chair Jay Powell that he will be fired should he not leave his position by May 15th. The president's adding that he has no plans on dropping the DOJ probe on Powell and the renovations on the Fed building. That's your Bloomberg Brief. John.
Yahira, thank you. Appreciate it. Up next on the program, credit concerns.
We have this entire ecosystem of private credit that has made it possible, has financed companies that probably would have struggled otherwise. We see it through the rising defaults in the private credit sector. The way this plays out is the way it always plays out. People want liquidity.
In just a moment, we'll catch up with the Schroders Capital CEO, Georg Vanderlyn. He joins us next, live from New York City. You're watching Bloomberg TV. Live from New York City, welcome back to the program. Your scores look like this. Equity futures on the S&P 500 just about unchanged, following a really fantastic run on the S&P, up off the lows by close to 10% and very, very close to all-time highs. Just think about that. We've shut down the Strait of Hormuz, hardly any traffic coming through, and yet we're this far away from from record highs on the S&P 500.
Yeah, and everyone's just trying to get past this so that they can look at earnings and talk about all the underlying momentum. My big takeaway, one, you could say complacency, et cetera. The second one is that the U.S. economy in particular was poised for an outperformance in economic growth that was so much greater than what people expected that this takes that edge off. So you're still seeing gains, even though they might not be as much as they previously might have been thought to be.
And based on reports so far this morning, it looks like the U.S. and Iran close to extending a truce. The ceasefire set to expire in the next week or so. The report from the AP came about an hour ago.
So it looks like potentially we're going to have this extend past April 22nd. Although if you look at what one of the officials said to the AP, they want three things hit by April 22nd. Iran's nuclear program, something on reparations, and the reopening of the Strait of Hormuz. While that is signaling the top line, they want to extend the ceasefire, there's other headlines coming out with Iran saying if one side violates a deal, the other party can too. And Tehran views the U.S. blockade as a violation of the ceasefire deal.
Things are still very, very fragile. They're not at the banks right now. Let's put it that way. Morgan Stanley in the pre-market higher by 2.5%. Earnings a little bit earlier on this morning, and those earnings were better than good.
Beats across the board. Their equities trading revenue, $5.15 billion versus the estimate of $4.78 billion. The opening line of Ted Pick's commentary heading this particular earnings season is Morgan Stanley reported a record quarter. Mic drop. And that is what you're seeing right now in markets.
And some commentary on private markets, private credit from basically all of these players over the last few days. The Bank of America CFO, I believe, on the call right now, talking about the firm not changing their private credit strategy and haven't seen any losses in the private credit portfolio.
There's been huge pushback from all of the executives at big banks saying, look, there are going to be some problem children. We do see some potential lending behavior that isn't exactly wonderful. At the same time, this is not systemic, and we plan to plow ahead. And that has been the theme from big banks.
Under surveillance this morning, credit concerns.
There are a number of operators out there that probably should have gone under even back in 2020 that are still around. And today we have this entire ecosystem of private credit that has made it possible, has financed companies that probably would have struggled otherwise. We see that through the bad pick activity. We see it through the rising defaults in the private credit sector. And the way this plays out is the way it always plays out. People want liquidity.
So here's the latest this morning. Wall Street banks reporting at least $100 billion of exposure to private credit firms as investors question the durability of the sector. Georg Vanderlyn, the CEO of Schroders Capital, writing weaker players are being exposed while stronger disciplined investors stand out. Georg joins us now for more. Georg, welcome to the programme and welcome to New York. It's good to see you, sir.
Thank you. Thank you for having me.
Can you help us understand the difference between a liquidity-driven repricing and a structural credit event? Just explain to us one versus the other and what you think this is.
Very happy to, and it probably links nicely to some of the comments made earlier and other executives in the industry. Effectively, what the market isn't really differentiating right now is liquidity stress in semi-liquid vehicles, so linked to structures ultimately in funds, versus impairments of underlying assets. So what we have is liquidity stress in essentially retail orientated structures, so funds that have been sold to retail investors. In some cases where probably these investors haven't fully understood what they're investing in. In some cases maybe compounded by the fact that there is software exposure and the market is trying to price software and revalue ultimately software in the light of upcoming anticipated software disruption. Note, it hasn't happened yet. And essentially the real distress or impairment of underlying assets, which isn't happening. And so that effectively is the difference between the two.
What does it mean for you and the team and the dislocations you've seen so far and the money that you're looking to put to work?
So, I mean, for us, just first of all, to note, we're not a direct lender. We are focusing on sectors which we think is the sort of the boring, sexy part of the new, the boring part of the market, i.e. sort of lending against infrastructure assets, lending against real estate assets, lending against, on an asset-backed basis, for example, against hard assets, where we have better collateral, which is less cyclically exposed. And I think to us, that is a key opportunity also going forward for investors to build more resilience into their portfolios by embracing this next to the exposures they have in direct lending.
At a time of rapid change, a dislocation, the idea of AI and what that could potentially do in transforming business, is there an advantage to being illiquid versus liquid with respect to your asset allocation?
I think it's, like broadly speaking, this gets to the advantages of private markets generally speaking. I think you want to be both, really. I think there is no way an investor can only be liquid or only be liquid. I mean, effectively, private markets roughly capture probably 80% of the economy, depending on how you count it. I mean, in terms of businesses in the United States, it's probably 99% of businesses are not listed. 80% of the workforce is working for non-listed companies. I mean, it's a bit hard to gauge, really. But it's such a big part of the economy. A lot of the innovation economy is actually happening in the unlisted space. A lot of effectively real assets, infrastructure, real estate is not really suitable for listings. And then there's obviously also bigger listed companies. And so in any portfolio, there will have to be both.
Do you think that illiquid assets need to have a higher bar for transparency, given that one of the big concerns is that a number of lenders are mismarking their books or marking aggressively and optimistically just how high some of the valuations could be?
I think the issue is much more how you deal with this in the context of semi-liquid structures or liquid structures where you can trade in and out of illiquid assets rather than effectively the time lag in valuations and the approach to valuations in illiquids in general. So you don't have a problem in illiquid funds ultimately, or in CLOs, even in the private credit space, really, where there is no trading in and out. So, essentially the daily volatility and themes which are played through the stock market, like, should valuations for software companies be lower now because there will be disruption in the future, even though earnings are still very much unchanged and very much in a good territory, isn't something that a private market fund would reflect on a daily basis. However, if you have investors that can trade in and out, either daily or on a quarterly basis, you all of a sudden have that issue translating into these types of structures. And I guess this is where ultimately the issue arises. And for me, the question is ultimately whether then investors fully understand what they've bought into, and the fact that the underlying asset is ultimately illiquid, and there are mechanisms that prevent single investors from trading out, from trading out. And contagion to spread to a broader group of investors just because of sentiment.
Clearly things haven't gone right for the industry over the last few months. With the minute we have left, what should the lessons be of the last few months for the industry?
So I guess, to say it maybe slightly provocatively, growing too quickly in certain areas, essentially, and selling too much of one thing, maybe with slightly too little diversification, too much sector exposure in certain areas, maybe also a degree of lack of discipline in terms of underwriting in the 2020s, pre the change in the rate environment, is something that has to feed through the system. Per se, that's not an issue, and it's also not leading to credit losses, to just say this again, and it's also not leading to losses in private equity, but probably a series of vintages that will have slightly lower performance.
Georg, thanks for making time for us this morning, and enjoy your time in New York. Georg van Dillen there of Schroders Capital. Up next on the programme, we'll catch up with Phil Camporeale of JPMorgan Asset Management, Max Layton of Citi, Pooja Sriram of Barclays, and Brent Schutte of Northwestern Mutual. The third hour of Bloomberg Surveillance up next.
The earnings story still looks very much on track.
You have a situation where the fundamentals actually got stronger.
There is still a lot of uncertainty out there.
This uncertainty can pass. I still think there's a very good road ahead.
The bull market that started in October of 2022 has further to go.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, this far away from all-time highs on the S&P 500 and into the rally, just about close to 0.1% higher on the S&P and just about unchanged on the Nasdaq following a 10-day run of gains. In the commodity market this morning, Brent and WTI fairly well behaved. Brent crude at about 95, WTI around 91, a fifth straight consecutive close below $100 a barrel at the front end of the futures curve in yesterday's session. That's set to continue based on these moves and based on the reports so far that the US and Iran is close to extending a truce.
Yeah, and this really has been what's been the ballast behind the market performance so far, is that you haven't seen an escalation, that talks have been ongoing. Yes, the Islamabad talks did break down with no agreement, but further talks are going to be held at some point. That's the reporting. So at this point, is not worse news good enough to keep this rally going, given the fact that we're getting earnings that are incredibly strong from U.S. companies?
And the president is signaling that, at least at this moment, Tehran has some distance right now from Beijing. In a Truth Social post, he said China's very happy that he's permanently opening the Strait of Hormuz. There's actually a blockade right now in the Strait of Hormuz, but maybe potentially down the road, the president is looking for a real opening of the Strait of Hormuz. And then this, they have not agreed to send weapons to Iran. This is obviously Iran's biggest backer because they buy the lion's share of their oil. And what he's saying is Beijing is maybe taking a step back. We will see. And the president will be obviously going to Beijing in May.
It's funny just to track how people's views on all of this has changed. At the start of March, if it goes on a few weeks, it'll be okay, just so long as it doesn't go into April. And now we're talking about the prospect of extending a truce without any real clarity on what that means for the Strait of Hormuz. And we could be talking about the strait still being closed by the time we get to May.
There's not really a clear pathway to get the strait reopened. That's the problem right now. And what you hear on the peripheries is that Iran rejected the UN proposal to open the strait to all commercial traffic without a toll. Remember the toll booth that's been set up? I mean, again, people are saying, yeah, stop it with the geopolitical noise. I just want to get back to my earnings. And right now, markets seem to be focused on that, even though you could come up with a pretty gloomy and doomy story about what's going on in the Middle East. And it's really not that far of a stretch. Talk to any commodity analysts, there they are.
No gloom in the bank earnings whatsoever so far this morning from Bank of America and Morgan Stanley. More trading records. Morgan Stanley in the pre-market higher by close to 3%. Bank of America up another 1 percentage point. Later on this morning, 10:45 Eastern Time, Bramo catching up with Ted Pick, the Morgan Stanley CEO, following some fantastic results earlier this morning.
The key issue is just how much is this potentially threatened by what's going on in the Middle East versus a big pipeline of deals that are slated to get done that a lot of banks have talked about. We talk about how the regulatory environment is more wide open for some of these tie-ups and how much capital markets can continue to boom to the extent that they did in the first quarter, even with some of the noise that people keep talking about in the background.
If United and American Airlines can get a deal done, anyone can.
Okay, go ahead. You're not spreading this rumor.
Imagine the pitches.
Okay, honestly, listen.
Think of the banks right now.
This is John this morning.
The pitches they're coming up with.
Okay, this is John this morning.
Excellent.
I'm not saying it, but what if Morgan Stanley were to buy Goldman Sachs? If, United
I'm sorry,
and American...
but if United can buy American Airlines, anyone can buy anyone.
All right, I'll ask him. I'll ask Ted. I'll say that John has a question for you.
Ask him about the United American Airlines deal and the potential of getting that done and what that could mean for other sectors, other industries, and the kind of deals that have to rethink the possibilities around.
Alphabet and Microsoft?
Chevron, Exxon?
Who knows?
You know,
sky's the limit.
Crazy talk. Think outside. Anyway.
Coach and Michael Kors. Never mind.
No, that's not allowed.
Let's move on.
Don't touch the handbags.
I won't.
Don't upset Biden. Bad news, that.
Okay, sorry.
Entry-level handbags.
I'm sorry.
Antitrust concerns.
All right, I'm leaving.
From one crazy to another. It's crazy. All right. Coming up on the programme, Phil Camporeale of JPMorgan with stocks trading near all-time highs. Max Layton of Citi on reports the US and Iran are close to extending their truce. And Sriram of Barclays as President Donald Trump ramps up the pressure on Fed Chair Jay Powell. We begin this hour with stocks hovering around fresh record highs. Phil Camporeale of JPMorgan Asset Management writing, the US in 26 is the most prepared to deal with a spike in oil prices than at any point in recent history. While we have reduced non-US equity, we have not adjusted our overweight to US equities. Phil joins us now for more. Phil, good morning.
Good morning.
Is this the return of US leadership?
So US exceptionalism is not going away, right? However, I think that the US is a clear winner here when it comes to the spike in oil prices, as I wrote. So let's kind of break this down a little bit. Obviously, 5 years ago, we went from an energy importer to an energy exporter. So lo and behold, we had our equity person talk to us earlier this week, and they've upped their earnings forecast from about 15% to 19% this year. Why? Because these energy companies are going to have a heck of a lot of earnings this quarter. Secondly, the One Big Beautiful Bill Act is coming at a one big beautiful time. Okay, so the estimate here is that gas prices would have to average $4.50 for the entire year just to break even with the fiscal policy that is being delivered in 2026 through the Big Beautiful Bill Act. And as we all know, tax refunds are hitting today. April 15th Happy tax day. 3 things that you can count on: death, taxes, and the 60-40.
Shots fired.
Which I want to get to. And then, like, forward-looking, I know that inflation expectations in the near term obviously are rising, particularly headline inflation that includes energy prices. But if you look further into the future, whether you look at the December 26 oil contract that's trading in the 70s, or if you're looking at five-year forward inflation expectations, which is something that the Fed loves to look at, those things really aren't moving, John. So, you add this all up, and the top 20% of earners, that basically determines success or failure for this economy. They care about every Thursday at 8:30 in the morning, which is initial jobless claims. Right. They don't really care about gas, energy, and oil prices. They only spend about 2.5% of their income on those things. So I think they're a little bit more insulated, and they're doing fine.
And claims have been super low. With regards to the war in Iran, there was a report earlier on this morning from AP that suggested the US and Iran was close, in principle, to agreeing an extension of the truce. This came from Axios just moments ago, that the US has not agreed to an extension of the ceasefire. That from Axios just moments ago, the US and Iran will continue to engage to reach a deal.
So it sounds like, from the United States point, they want to keep talking, but they have not agreed to extend that April 22nd deadline. Maybe this will change, but right now it seems that the United States still wants to really squeeze and put the pressure on Iran to come to the table and almost capitulate before April 22nd.
We'll have our own fight around this table now and talk about something completely different. Do you want to take it away? 60-40.
Well, it's related. I'll tie it together. And it's this idea of, at a time when the commodity shock is the significant potential shock, does 60-40 work? You are going to die on this hill. I just wonder if you see right now an ongoing correlation, positive correlation between stocks and bonds, because the potential risk factor is inflation. How can you say this is still going to work?
Yeah, so Lisa, I did think of you when the 60-40 was hurting my feelings in March, as stocks were going down
be in good time.
And bonds were going down. But I thought it was something really important. Once we priced out the Federal Reserve from all of their easing this year, the 2-year note stopped going up in rate, right? So I think there was a limit to that. Oil prices went up, had to price out I don't think the Federal Reserve should be easing policy over the next 6 months anyway. Every single one of their meetings is a cost-benefit analysis. Does the benefit of a hike, a cut, or staying on hold outweigh the cost of potential policy error? They shouldn't be easing. But the 10-year note's at 4.25 right now. We were at 4.1 in September of last year. Like, the MOVE index is really our guiding light, because I think that kind of controls everything. The MOVE index controls whether the 40 will protect the 60, and I think at this point we think it will, because we don't see tightening. Once you price out the easing, now you can start to get the benefit of diversification. But you had to go through those painful couple of weeks to get there. And then what the MOVE index, which is rate volatility, also does is it allows you to go buy equities. As I wrote, we never reduced our U.S. equity allocation. We still have an above-trend GDP forecast this year, even if oil prices average $88 for the whole year.
This is the contradiction, and we've talked about it a lot on this show, that if you expect growth to outperform, and you expect commodity prices to inherently be higher going forward than they would have otherwise been because of blockages and questions about the freedom of navigation on the seas, then why wouldn't the stronger growth be inflationary, given the fact that we're already at a higher than target inflation for the past more than 5 years?
Because it's not showing up on, I would say, kind of the supply side. So if you look at wages, if you look at shelter, right, the stuff that really drove up inflation in years like 2022, you're only seeing it on the commodity side. And I think it's okay for service sector to be sticky here, Lisa, because I think what that's saying is that you have a strong consumer. Right? So it's all kind of circular into a positive earnings growth story and an above-trend GDP growth story, along with the fact that you, again, have this One Big Beautiful Bill Act that's providing. Now, the Fed shouldn't be cutting rates. That's not in our forecast. And I think it's not in our forecast because we do have inflation probably closer to 3% than 2% for the remainder of the year. But to make these links back to 2022, which gives asset allocators like me a whole ton of PTSD, right? I don't want that. You have to then add in the other parts of inflation, the shelter. The owner's equivalent rent was a huge driver there, and we're not at that level right now.
I think the greatest counterpoint is just the lack of labour wage growth right now. This labour market's not as tight as it was back in 22. I'm not saying it's super loose either, around 4.5% unemployment, 4 to 4.5 at the moment, but you're not seeing the wage growth that would make most people worried about an inflationary spiral from here.
I love this.
And that was March, I think John's right, but March of 2022, that wage price spiral risk was so prevalent, which is why the Federal Reserve eventually had to hike by 75 bips a meeting, 4 meetings in a row. And then just the other piece on equities, which I think is important. There's $22.7 trillion right now sitting in checking accounts, savings accounts, and money market funds. You know what that's yielding right now? Even at Chase, but you didn't hear it from me. It's yielding 52 basis points.
Yeah.
Like, investors are stuck in ZIRP, but these banks, right, can then charge a 6.5% mortgage rate. I mean, that's amazing.
I love it. I'm the embodiment of PTSD from 2022. That's great. You know, when they want to think of something, they think of my face. All I can say is, you know, it's a good pitch.
Yeah,
I like
you look
it.
like wrong way correlation. That's right, exactly.
That's brutal. Stocks down 10% and people think of Bramo. Is that how this works, Lisa?
I think that's great. That'll be my Halloween costume.
Phil, you're a good sport. Appreciate your time as always,
Good
buddy.
to see you all.
Thanks for being here.
Thank
Thank
you.
you. Phil Camporeale there of JPMorgan Asset Management. Let's give you an update on news worldwide with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. We're seeing shares of Bank of America rising 0.8% after reporting first quarter earnings that beat estimates. The bank reporting record equity sales and trading revenue. CEO Brian Moynihan saying the results indicates a resilient American economy. Morgan Stanley also moving higher, up 2.7%. The investment bank reporting a record first quarter with equity sales and trading revenue well above estimates. Lisa will be sitting down for an exclusive interview with Morgan Stanley CEO Ted Pick at 10:45 a.m. this morning. And New Jersey Transit is considering charging World Cup fans over $100 for round-trip train tickets between New York's Penn Station and MetLife Stadium. It's a pretty short ride. New York Governor Kathy Hochul called the fare awfully high. That's your Bloomberg brief. John?
Yahara, thank you. I'm trying to work out if I should save you from this or not, but...
Ridiculous.
I think the answer is no.
We're going to have
Goodbye.
months of this conversation. I'm so disappointed with how this has been handled in this country over the last year or so. I'm so bullish this game in this country, and you see youth teams all around the Northeast taking up football, soccer, and I think that's absolutely fantastic. When we had the World Cup in the US in '94, it wasn't the right time. This was the right time. It was a massive opportunity for this sport. All the kids should have had fantastic access to get into the stadiums to watch these games for next to nothing. And the idea that we're talking about $100 just to get a rail ticket, that is so sad. I think it's really sad the way this has been handled.
And then you add on top of that the cost of the actual tickets.
Yeah.
I mean, this is the reason why, you know, on one hand, this is what America does best, right? Everyone has their hand out if they can profit, if the demand is greater than the supply. At the same time, it's not really going to get my kids to the game because I ain't paying that.
Right?
And Italy didn't even make it, John.
Oh, Phil, what are you doing?
Oh, no. Now you're...
What are you doing?
Now
tweak us all.
Shots fired.
How dare you with that last name as well?
I'm half Irish.
Up next, we're not doing that. The morning calls, plus Max Layton of Citi with oil rising on mixed messaging out of the Middle East. That conversation and not football from New York City this morning. Good morning.
In terms of the stocks, there was a window to buy a couple of these maybe at the beginning of the war, and we upgraded a handful of the regional banks during that period of time. But we still think that the risk-reward trade-off is better in some of these regional banks. JPM and B of A probably had the best quarters. The stocks came in relatively hot. We have erased all of the war fear and losses going into earnings.
That was David George of Baird weighing in on the bank earnings this morning. We heard from Morgan Stanley and from Bank of America. Those numbers better than good. Equity futures just about unchanged on the S&P 500 following a stellar rally in this equity market. We've heard repeatedly from the banks on Wall Street. This consumer and this economy is resilient. We heard that from Brian Moynihan at Bank of America. From Jamie Dimon, consumers are still earning and they're still spending. From Wells Fargo, spending has been very resilient through the last month. We've heard it repeatedly. over the last week.
And they go on to say that just because oil prices are high doesn't mean that they're going to stop spending, because ultimately, as Jamie Dimon came out and said, it really depends on the labor market. And the labor market is strong. Until you see unemployment really creep higher, you're going to see this ongoing resilience that can continue to power the U.S. economy.
Futures just about unchanged on the S&P. That's the price action. Let's get you some morning calls. First up, Piper Sandler lowering its price target on Wells Fargo, the firm cutting its EPS estimate for this year and for next. Your second call from Barclays raising its price target on Citi, saying earnings are proof of a strong start to the year. And finally, Goldman lowering its price target on JPMorgan, noting increased competition and market volatility. That name is up in the pre-market by 0.4%. That's the bank earnings. Let's turn to energy. Crude rising as Iran pushes back on the US blockade of Hormuz, warning if it continues, it will violate the terms of the ceasefire. Max Layton of Citi writing, in a scenario of lasting disruption of the strait without major escalation, we could see oil prices relatively stable at higher levels with lower realized volatility. Max joins us now for more. Max, welcome back to the show, sir, and thanks for making time for us. I know you're looking at a range of scenarios. I believe there's 3. So could you detail the 3 and just tell me which one you think is most likely and why?
Sure. Yeah, so I think because this problem is so big, the baseline view that we've taken, that I think the equity markets certainly seems to be taken, is that this is so big it has to be solved, either militarily or diplomatically. And we had kind of penciled in around now and over the next couple of weeks, so second half of April, as a time where that was our baseline view, that's when it's going to happen. And look, it's still possible. Still possible. We put a 50% indicative probability on that scenario. In that scenario, we still think the baseline view that we still think it gets worse before it gets better. The two sides, or at least on nuclear, are pretty far apart. And, there's also talk about Iran saying how much, I've seen numbers out there of up to $270 billion of damages that they want. And look, they want a kind of reparations for. So I would say that things look pretty far apart. A lot can happen within a couple of weeks. I mean, a couple of weeks is a very long time. But in any case, we see the price kind of grinding up over the next couple of weeks to $120 is our 0 to 3 month point price target. That's a central scenario. And then it getting resolved diplomatically, most likely. But, we also put a 30%, we're certainly not out of the woods, I would say. We put a 30% probability on the bull case scenario for oil, which is that this drags on for quite a bit longer, or that it involves mutual energy infrastructure destruction. And I actually think that mutual energy infrastructure destruction is much less likely now. I think the bull case is really about the Strait of Hormuz flows being disrupted for, let's say, for example, if they were disrupted to the similar magnitude to what we're seeing today for the next 10 weeks, then oil and product inventories would fall to their lowest levels in over 25 years of data that we have, and most likely to the lowest levels in terms of days of consumption since the 70s. So, with that, you would see in this bull scenario, Brent up at 150, product premiums at 50, and all-in prices at $200 plus. So we're 10 weeks away from that, and it's entirely plausible that happens. And then the bear case scenario. The bear case is just really quick. It's just super, super quick resolution. You get a reopening of the strait almost immediately.
Isn't the market kind of pricing that in right now? Even though Iran is talking about retaliation, the market is weighing more heavily on the fact that it looks like they want an off-ramp between these two sides.
Yeah, I think in many ways. I mean, look, even the back end of oil at $80 odd, 12 months forward is, it's telling you that, it's telling you, that the market's super tight right now with spot trading at 130 to 150, depending on the oil, the crude barrel you're looking at. But it also does tell you that the market, at least in oil and probably also in equities, that it is assuming that this is solved pretty quickly.
What does solved mean, Max, given the fact that we're hearing a ceasefire, but it's unlikely, as pretty much every analyst says, that the Strait of Hormuz will actually reopen to the degree that it was before the conflict?
Yeah, I think solved is, it is a path to returning those flows probably it will be some kind of phased trust building return of flows in that baseline view. But, look, there is that entirely plausible other scenario that I think, arguably the market is complacent about, is that this drags on for a lot longer and or that the conflict restarts in a couple of weeks' time.
Are you sick of thinking about this? And I ask this because I think that the rest of the market is. I mean, I think that really that's part of the issue, is that people are exhausted by the headline roulette, and so they're just discounting it altogether and moving on. I mean, is that sort of your sentiment too?
Yeah, I mean, look, it has been exhausting. I'm spending half a day on X and on Bloomberg trying to figure out what's going on. But yeah, I think people in general are kind of hoping for the best and getting on with their daily lives. And, I have been, and I think that's reflected in our base case scenario. But, wow, it's I think when I look at the risk skew, I think it's entirely plausible that this regime, that the ceasefire works for them in the sense that if they can just hold out for, let's say, 10 weeks in that scenario, you're going to drive oil inventories down to the lowest level in decades, and you're going to drive up the oil price, and you're going to be able to probably maximize your ability to extract something from the negotiations.
Max, can I just finish on this question? And it's an important one, I think, in the 45 seconds we have left with you. There's a lot of people in other asset classes taking comfort from how the futures curve is positioned, how it looks, the deep backwardation, that prices looking out further in the future are a lot lower. They look at that almost as an implied market forecast. Do you see it the same way as a commodity expert? Do you look at the curve and see that as a market bet, or does it reflect something else?
Oh, wow. This is a big debate. And in my career in commodities, I've worked with different PhDs who have different views on it. I think your traditional commodity expert would say the forward price 12 months forward, 12 months forward is not a forecast. It reflects the convenience yield and the tightness today. So the fact we're trading at 150 reflects the tightness today, and the backwardation is not a forecast. But, everybody also knows that, the just logic tells you that the market is trading at that price. And if it was so far from people's expectations, then it wouldn't be trading there 12 months forward. Yeah. So I think the further out on the curve you go, the more it becomes, the less tied to the front and to the tightness it is, and the more it is an expected value. There's a big debate in the literature about whether that's 12 months out or 5 years out, depending on who you work with, yeah.
We'll get into the books another time. Max, it's good to see you. Thank you, sir. Appreciate your time. Max Layton there of Citi. Up next, Sriram of Barclays, as President Donald Trump is ramping up the pressure once again on Fed Chair Jay Powell. Live from New York City this morning. Good morning. You're watching Bloomberg TV. Only one down day so far this month on the S&P 500, and it was tiny. It's like this small. Equity futures just about unchanged on the S&P, following a fantastic run on the S&P 500. Energy stocks on the S&P so far this month, down 9%. The Nasdaq so far this month, up 9%. The Nasdaq 100 on a 10-day winning run, the longest since November 2021.
All you can really count on in this moment, where even Max Layton is saying, I don't know what's going to happen, we're all sick of talking about what's going on in Iran, and yet we're just sort of headline chasing, is that people keep investing in tech. And tech keeps outperforming. And ASML actually upgraded their forecast. So for all of the noise elsewhere, that is one constant and is viewed as an existential threat, which is a reason why people are piling in. This is the new haven.
Semi's up by more than 20%, I think.
Bonkers.
This month. The Kospi is up by something like 20%, I think, this month.
When you take a look at the 10-day gain, going back for the stocks, for the semiconductor index, it is the biggest 10-day gain going back to 2002. That gives you a sense of just how much of a rip it has been.
Absolute rip. Super impressive rally. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We're wrapping up bank earnings with more of the same. A trading bonanza on Wall Street. We start with Bank of America. Shares up 1%. Traders there pulled in the unit's highest revenue in more than a decade, and Morgan Stanley right there with it. Shares are up 2.6%. Equity trading jumping 25% to a record of more than $5 billion. So to sum it up, volatility fueled activity across Wall Street, turning into a windfall for these banks. Turning to another name in the green, and that is Snap. Shares are up 6.4% in the pre-market. The social media company announcing it's cutting 16% of its workforce as it tries to achieve profitability. And notably, CEO Evan Spiegel pointing to AI as one of the reasons the company is able to do more with less people. So that's what investors are reacting to, the idea that AI can drive efficiency. And we are also seeing shares of Broadcom rising nearly 2% in the pre-market after expanding its partnership with Meta to build custom AI chips. This is part of a multi-billion-dollar push to build out more than a gigawatt of computing power. John.
Yahara, thank you. Thank you for that. Broadcom with a fantastic run as well. Let's turn back to the Federal Reserve. President Donald Trump saying he'll fire Chair Jay Powell if he doesn't leave his position on time. Mike McKee has more on that. Good morning, Mike.
Good morning, John. Yeah, another threat from the president. But before we get to the Fed, I just want to mention that we did get some economic data that will make the markets happy again today. Import prices rose 0.8% in March. The forecast was for a 2.3% rise. So like PPI yesterday, better news. And almost all of that was oil prices. Ex-petroleum import prices were up just 0.1%. Empire manufacturing, also big jump up to 11 from minus 0.2. So some good news on the economy this morning, and it might keep the Fed sidelined. Whether the president can sideline Jay Powell or not is another question. He, once again, speaking with Maria Bartiromo, said that if Powell doesn't leave on time, he would have to fire him. But that's not up to him. That's up to the Supreme Court. The Lisa Cook case still hanging out there. We hope to get a decision sometime soon on whether the president can fire somebody on the Federal Reserve Board without specific cause. So that's kind of off the table until we do. There are legal questions about what happens if Powell's term ends as chair of the Board of Governors, and that might be fought out in the courts. But he would stay on as FOMC chair, the interest rate setting panel, because they've already decided that he would do that, and that's not subject to the president's decisions. Of course, we get Kevin Warsh's confirmation hearing next week after he finally got his paperwork in. Part of the reason for the delay is he's got a lot of money and he had a very complicated financial disclosure form. But there's no vote scheduled yet because Senator Thom Tillis is still holding out, saying the probe has to end before the Justice Department probe has to end before he would vote in favor of Kevin Warsh. And we heard just last night that the Justice Department showed up at the Federal Reserve and tried to go into the buildings to do an exploration, and the Fed's lawyers told him, no, you can't do that. You have to have a subpoena, and the subpoena was quashed by the judge. So the battle on that still goes on. There will be some interesting questions for Powell, for Kevin Warsh next week, of course. The biggest one is he going to work for Donald Trump, or is he going to work for the Fed? In other words, is his priority cutting interest rates over everything else? And if he's going to wait and see what the data tell him, when would rate cuts be appropriate? He wants to change the Fed's balance sheet, so I'm sure there'll be questions on that. And then, of course, his own $190 million plus balance sheet, and that only is his money. His wife is a billionaire, so there is quite a bit of questions about whether that will influence any of his decisions. So it's going to be a big week next week, and we're still waiting on the Lisa Cook case to see where that takes us.
And Mike, just what are you implying? Just that last line. That last line, what are you implying? That somehow he would set policy to benefit himself because he has $200 million?
Well, it's not so much that. It's that policy could inadvertently help him or his wife because the holdings are so vast. Now, he has said, as part of his disclosure, that he will recuse himself from anything that could possibly affect his portfolio, which he would, for the most part, sell off, but affect the Estee Lauder companies, which is where his wife gets her money from. So it's a question about, how do you manage something that is so big in your own portfolio and stay out of trouble?
Interesting. Mike, thank you. Thanks for breaking that down. Appreciate it, as always. Fair to say you married well. right?
Yes, exactly.
Kevin Warsh doing okay.
As Mike's talking, and it's like his paperwork was so delayed because there's so much money, because he married well.
I don't think that's a man who needs to work for anyone, right? Never mind the president.
Well, and this is the reason why I think some people would say, okay, he's fine. He's going to be the Fed chair and he'll be relatively independent. I feel like this is sort of a normal pathway. You get enough to be independently wealthy before you take the salary of a Fed chair.
Chairman Powell also independently wealthy.
I mean, pretty much that's a nice pathway.
Yes.
My son said to me the other night, he's like, what about me? And I'm like, yeah, go to.
Oh, he wants to be the Fed chair?
I think more Treasury Secretary.
Oh, right. He's got big plans.
I was like, yeah, good luck to you.
I've met him.
Maybe just graduate from high school first.
I imagine that's possible for him.
All right, well,
who knows?
Please, I hope he's not listening.
All right.
Please don't inflate your ego.
I imagine he is. So you go for it. You go for it. Pooja Sriram of Barclays writing this. We think there is likely enough support in the Senate for Warsh's nomination to proceed. The path for a timely confirmation, however, seems narrow. Pooja joins us now for more. Pooja, good morning. Good to see you.
Good morning.
Let's get into this. So we've had all these attacks on the Federal Reserve. Have you seen any real credible effect on the operational autonomy of the Federal Reserve that's really harmed them, actually taken place? Never mind the risk of it happening. Have you actually seen it happening?
Not at all. I think so far it just seems that this is background noise, unnecessary noise that, you know, Chairman Powell is having to deal with. But, you know, we listen to the FOMC members closely. We read the minutes. It doesn't seem to have affected how they're functioning. I think what this does is this constant attack. And like, you know, we said that, you know, the path for, you know, Warsh's nomination was already quite narrow in the first place. And then you have this attack. And, you know, as Michael McKee just pointed out, it sort of creates a potential roadblock for that happening in time. And so, you know, it's political, no doubt, and it could get messy.
Has it changed how you think about leadership of the Federal Reserve and what a Chairman Powell Fed looks like compared to a Chairman Kevin Warsh Fed?
Well, yeah, I mean, we do know, you know, how Warsh thinks in terms of, you know, he's more hawkish on the balance sheet, but there is an inclination for him to cut rates. So, you know, he is perhaps, you know, one more dovish member to come on board. But we've always held the view that, you know, irrespective of who's Fed chair, one person cannot entirely influence monetary policy. And so I think that the big job of a Fed chair is to build consensus, and you need to have credibility to do that.
One of the most amazing aspects of all of this, whether it's Fed independence, whether it's a commodity shock, whether it's the fact that inflation has not been at the 2% target or below the 2% target for more than 5 years, is that inflation expectations are incredibly anchored. They are. If you take a look at five-year break-even rates, they've creeped higher to 2.2%. Oh, horror. You know, like this question of what are we looking at right now? Do you think that this is stable and that this is faith in the Fed, or do you think that this is just simply complacency?
No, I think this, to a large extent, reflects Fed credibility. And, you know, forget the markets. You look at consumer surveys, right? And you think about the average consumer and what inflation expectations they're pricing in. We're not seeing the longer run expectations move up there either. So I think so far there seems to be a belief that this energy price shock is going to be, you know, to use that word, transitory. And then, you know, hopefully things pass over. But I think the longer this continues is when consumers, the average consumer, starts getting worried.
To preserve the Fed's credibility, do they have to move to more of a range, a 2 to 3% inflation range, rather than the 2% target that they haven't met in more than half a decade?
No, I think they're going to be extremely hesitant to make any changes on that front. I think the idea would be for them to perhaps, you know, keep rates more restrictive if they're seeing signs of inflation, you know, remaining sticky or elevated. One thing that sort of worked in favor of their current policy stance is, like you said, inflation expectations. The other thing is, sure, I mean, you look at the annual numbers, they're elevated, but you look at the monthly prints. I mean, core CPI has been surprising, you know, to the downside for, you know, I want to say at least 10 out of the last 11 months. And so those outcomes are something that they will likely sort of take signal from. The other thing I would say is, you know, if you sort of break down inflation into core goods and shelter, and then the core services ex shelter, the sort of framework the Fed likes to follow, core goods surely has moved up in 2025. You can say that's a tariff story. And, you know, by our estimates, we think that's about to wind down. You know, much of the tariff pass-through has come through, and we don't expect any incremental inflation on that front. Shelter is, in fact, in disinflation. It's a good, you know, chunky part of CPI, so that's, you know, doing a lot of the heavy lifting. And then core services ex shelter, you know, a bit sticky, but we're still sort of moving in the right direction. So, you know, if you're the Fed and you're watching that, you could be hopeful that things are moving in the right direction.
Under Kevin Warsh, do you think there could be a real conversation about changing how they target inflation, maybe to target a range instead? Because this is something the Treasury Secretary has spoken about prior.
Yeah, I mean, we don't have a view on what, whether he intends to do that, whether he, can do it so quickly. I think when he comes in as Fed chair, I think it's likely to be status quo initially before he can sort of build consensus, get more people on board. We think that the thing that he might want to do first is something on the balance sheet front rather than, we've been asked about Fed communications. We don't think that that's on his priority list.
Get rid of the dots. Get rid of the dot plot. I think people have been talking about that for ages, haven't they? Why not just take the opportunity? Just dump the thing.
That would be sad for me because I remember
you want to keep them.
Because when the dots came out, I remember the newsroom had dot cupcakes, and people would come out with different cupcakes with different dots in different places.
I find that sad.
Yeah. I'll get you a cupcake.
I think it's lovely. I think it's really sweet.
Cakes,
they were blue. They were blue dots.
Is that the only time anyone brought in cakes? We'll talk about this another time. All right.
On the couch.
Have a little session.
Exactly.
All right. Pooja, good to see you. Thank you. Pooja Sriram there of Barclays. Let's give you an update on stories elsewhere. That's sad. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Mediators between the U.S. and Iran are moving closer to extending the ongoing ceasefire before it expires next week. The AP reporting Washington and Tehran had given a, quote, in principle agreement to extend the truce, allowing for more diplomacy. President Donald Trump warning Fed Chair Jay Powell that he will be fired should he not leave his position by May 15th. The president adding that he has no plans on dropping the DOJ probe on Powell and the renovations on the Fed building. And Starbucks and OpenAI are teaming up. The coffee giant launching a new beta app in ChatGPT today. Customers can type at Starbucks in ChatGPT to discover and customize their drink before finishing checkout on the company's app or website, or just go in store. That's your Bloomberg Brief, John.
It would be easier. Yahara, thank you. Appreciate it. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Brent Schutte of Northwestern Mutual Wealth Management, with stocks hovering very close to record highs.
I think that the U.S. is a clear winner here when it comes to the spike in oil prices. Inflation expectations in the near term obviously are rising. But if you look further into the future, whether you look at the December 26 oil contract that's trading in the 70s, or if you're looking at five-year forward inflation expectations, those things really aren't moving.
Inflation expectations are super anchored. That was Phil Camporeale of JPMorgan Asset Management. Lisa, you said it earlier. We've said it repeatedly on this programme. Despite everything that's been thrown at this institution, the Federal Reserve, the criticism from the White House, the oil price shock in the Middle East, somehow inflation expectations are super anchored.
Which is the reason why Phil Camporeale is going to die on the hill of 60-40, continuing to reassert itself, because ultimately that downside protection still is in the bond market. And that's ultimately one of the key questions, given the positive correlation so far this year, that I've been noticing.
It wasn't much fun in March. Let's put it that way. Well, it really wasn't.
It's the 2022 playbook that burned so many people, and that PTSD. I still kind of feel it, but I guess other people have moved on.
Moved on quickly. This equity market's moved on very fast. Prematurely? We'll find out, but moved on very quickly. Equities up again this morning by 0.1%, and going into the cash open about 42 minutes from now, very close to all-time highs. As we count you down to the opening bell, your trading day for the week ahead and into next week looks like this. At 1 p.m. Eastern Time, a White House press briefing. At 2 p.m. the Fed's beige book. Thursday, we'll have another round of jobless claims and earnings from Netflix. Looking ahead to next week, Senate confirmation hearing for Fed Chair nominee Kevin Warsh taking place on Tuesday, or at least set to take place on Tuesday next week.
Yeah, I was thinking maybe, because ultimately Tom Tillis really does hold the keys over a lot of these machinations about the hearing, because he has said he is going to oppose this hearing. He is going to prevent Kevin Warsh, who he supports, from getting even confirmed because of the ongoing probe into the Fed's construction.
The president wants to see Kevin Warsh confirmed. He appointed him, of course he does. Wants to see that happen. He also wants the DOJ probe to continue and the Fed chair, the current one, to get off the board. Those three things don't line up right now because of the player you mentioned, Senator Tom Tillis of North Carolina, and the chairman of the Federal Reserve, the current one right now, who said himself that if the investigation is ongoing, he's not going anywhere.
Yeah, so at the moment, basically, you're going to have a standstill until someone blanks. Is it going to be Senator Tillis, or potentially is there a way you can get it through the floor with a number of senators voting basically via discharge position, or the DOJ drops that probe? I don't see that happening. But this could just live in the hearing. Senator Tillis, I think, will be happy to have the hearing. It's just whether or not there will be a vote to get Kevin Warsh out of the hearing onto the Senate floor.
It's a story for next week in the here and now, very close to all-time highs on the S&P 500. Brent Schutte of Northwestern Mutual writing the following. Investors have taken comfort in strong earnings forecasts for 26. Commentary in the coming weeks will be crucial in validating how businesses are truly navigating higher inflation and higher energy costs. Brent joins us now for more. Brent, welcome. Are you convinced that we'll get that validation from the C-suite in the coming weeks?
I am not yet convinced. I think the reality is that investors have focused more on those strong earnings kind of as a security blanket, so kind of the tiebreaker, because the economic data has been a bit mixed. But in the interim, they focus more on the fact that the ceasefire is held, and there's this belief that President Trump values the equity markets and that if he has the opportunity, he will pull back. Plus those earnings expectations, which analysts are usually slow to mark them down. And so that's where I think they focus on the strong earnings that are out there right now and the expectations. But let's hear what company executives have to say about how they're navigating the future. And I think that will set the tone, certainly for the next few days and weeks as we look ahead.
So, Brent, we know what the calendar looks like for earnings. Which sectors, which pockets of this equity market are you not comfortable with at the moment and you're waiting to hear from management teams?
You know, I think investors have bid back up the markets, and they've gone back to their old favorites. They've gone back to the things that had worked for much of the past 3 years. They've gone back to non-profitable tech, ironically. They've gone back to the Mag 7. If you do believe that the economy is going to continue to push along and that the conflict will pull back and that will be just fine, you want to go back to what was in place prior to that, where you saw this broadening that was occurring into small and mid-cap stocks. Which started basically back in October of last year when 5 of the 7 Mag 7 names actually announced earnings, the Fed cut rates, and investors started thinking about a broadening economy pushing forward. That's where I focus more in the long term because I think the shorter term is a bit uncertain, but certainly with the chance of a pullback overall, just given the fact that the economy is still showing signs of weakness despite the comments about resilience.
How much are you seeing a change, though, in overall backdrop based on what's happened in Iran, what's ongoing in Iran, and the expectation that commodity prices are going to remain higher for longer? Do you think that nothing materially has changed that potentially favor big tech, say, over mid and small cap stocks?
This is where I think if you look at this quarter, it was expected to grow around 3% when we started it because of the impacts of the One Big Beautiful Bill, the deferred spending from the government that shut down in Q4, plus the monetary policy stimulus that we received last quarter. And this is where I think that is what's held the economy in there. And I think that stimulus will still be there if we can get past the conflict. And that's where I do believe if the conflict does pull back, if interest rates remain well behaved, which I think is even more important than oil. I think people are kind of missing that interest rate commentary a little bit. If that happens, that's where you will see this broadening that was occurring prior to that. And this is where I like, as a strategist, having a couple different outs. I like being in things that are cheaper and underappreciated. And that's where if you look at earnings estimates going forward, the forward 12-month earnings estimates on the S&P 600 is around 17.5%, and you're paying 15 times for that, versus the S&P 500, which is a similar 17% growth rate, but you're paying 22 times for that. I like having valuation on my side in a trade because it can bail me out. I don't have to think about the next 3 or 4 months. I think a little bit longer term, and that's where I like the setup there just a bit more. From the standpoint of where I think value is and where I think we're going in the longer term.
You talked about rates commentary, so let's go there. There's a question about what the direction of the Federal Reserve is going to look like under new leadership, potentially, and the brouhaha that's brewing in the latest soap opera down in Washington, D.C. over the new Fed chair. How closely are you paying attention to this and whether the president's going to drop the probe into the Fed's construction or renovations, and whether we could get Kevin Warsh in the seat by May?
I think it's one of those things that's still out there that beyond the conflict, you still have the questions over what happens with Kevin Warsh if he does become Fed president, and what happens with the president's wishes versus what the market is pricing in right now. You have the midterm elections coming up, and you have tariffs, which quietly have come down the past few months as the IEEPA came off, but they're, I think, going to go back up in the future. And so I think there are still plenty of things to worry about. I think the biggest commentary that people are missing just a bit, which I heard the conversation that you just had about inflation expectations in the Federal Reserve. look, we haven't been, as you mentioned, at the Fed's 2% target for 5 years. And it's been a series of excuses. It was COVID, then it was tariffs, then it was oil, and it was transitory. At what point do people start believing this is more of a permanent thing? And at what point does that begin being priced into the market? And that's where I think you see that risk. On the opposite side, you still have a labor market, which has recovered the past 2 months or 3 months. But if you look at the hiring the last year, since the beginning of 2025, it's all been and more in health services, one narrow segment. And so I think there are still risks out there, but I do think if you look intermediate to longer term and start thinking about that, that's where, regardless of these risks, I like things that are cheaper. I like things that are underinvested. And that's where I would still focus more on those small and mid-cap stocks. And I also think that investors need to think about the 60-40. You need to own some commodities, something that we have owned for much of the past 5, 6, 7 years. That's where I think there are two-sided risks going forward, not one-sided like existed for the past 15, 20 years, where it was just hedged by using long treasuries. Now I think you need to think about inflation being more permanent, maybe tied back to that Kevin Warsh commentary and where the president would like monetary policy to go.
Interesting. Brent, you're a class act. We appreciate your time. Brent Schutte there of Northwestern Mutual Wealth Management. One of the last lines there on inflation being above target for the last 5 years, I think is really important. The chairman was asked about the supply side shocks that we've seen. And I would have to say in the news conference, they were almost dismissed as just something that was happening out there that we couldn't control. Some of these supply side shocks have been choices. They've been more frequent, and some of them have been choices, which is why some people think they're going to see more to come in the future. And this is something you've got to adapt to as an institution, not just sit here and say it's come out of nowhere. We can't do anything about it.
And frankly, there is a structural incentive for nations and for companies to build up their concept of security and independence. And what that requires is investment and more commodities, more of the industrial renaissance that some people were talking about, which leads to higher prices, higher costs that are embedded in the system because of all of these choices, as you say. So this does change the backdrop a bit.
The Fed has also decided to make a choice to basically accept inflation at 3%, not 2%. They made that choice.
That's been the story of the last 5 years, for sure, and has certainly not been the objective of this Fed to damage this economy, to get inflation down to 2%. We've certainly not seen that with Chairman Powell. Programming note for you, coming up a little bit later this morning, 10:45 Eastern Time. Bramo catching up with Ted Picker, Morgan Stanley. Look out for that tomorrow. Ramping up coverage from Washington, D.C. We'll catch up with Max Kentner of HSBC, the Barclays CEO, CS Venkatakrishnan, the former New York Fed President, Bill Dudley, and the Franklin Templeton CEO, Jenny Johnson.